get started. So I'd like to welcome all of you to the first GIC DAVE Economic Forum. GIC is the Governmental Independence Center. DAVE, for those of you that don't know us, is the Denver Association of Business Economists. Also want to thank all of our panelists for volunteering their time and their insights to all of us here. We'd like to thank our sponsors because it is no small feat putting this together, so having the help of sponsors is greatly appreciated. Citywide Banks, which is a local community bank here. They've been around for 50 years. As we're going to be discussing economic issues that are facing us now, there's been no shortage of them over 50 years. So the fact that Citywide Banks is still here and still going strong is a testament to them. Also like to thank Cumberland Advisors. David Kotak can speak to their background. I also want to thank CU Denver for their help in helping us use this space. And want to give you a little background on DAVE for those of you that don't know. Denver Association of Business Economists. We meet once a month. We have a luncheon meeting more often than not at the CU Denver building at 15th and Lawrence. We'll have a box lunch, a keynote speaker. Sometimes we'll have a national speaker. Oftentimes we're going to have a local speaker. Tend to be very topical, very diverse topics. And for those of you that are interested, the DAVE summer event will be this Wednesday. The topic is the cannabis industry. All of us economists are kind of curious as to how that works and what's going on. It's our summer event. This is our only event that we do that is an evening event. It'll start at about 5 o'clock. We're actually doing a tour of some of the grow houses and the facilities, and then we're going to have a couple of industry representatives give a little presentation on how all this business works. So if you're interested, you can go to the DAVE website. There's something in the program that you can look at, but it's davedenver.org. And with that, we're going to do a global overview. We're going to get insights from a central banker, and we're going to try and tie it all together and see how it's impacting us at a more granular domestic industry level. Hopefully it'll be worthwhile to you. There's no shortage of questions that we're all trying to address. Brexit, we've got elections, we've got interest rates that I would wager to say that most of us in this room do not expect long-term rates to actually be moving lower throughout the year. So hopefully we'll get some answers as to where we're at and where we might be going. And with that, I'll hand it over to David.
Ron, thank you. A year ago, Mike Englund, who's sitting in the back of him, raise your hand, Mike. Mike and I were sitting over a meal, and I said, the Global Interdependence Center goes everywhere in the world. We have 8 conferences out of the country this year and numerous ones in the United States. And the only foreign capital we haven't visited is Denver, Colorado. And that led to introductions, which led to a working relationship with Ron. And Ron, just thank you so much for all that you've done, and we've partnered together, and this is a first for the Global Interdependence Center. Jill Fernito, some of you have met, is our executive director and organizer. Without her, things don't happen, but things like this do happen because of Jill. So Jill, we thank you very much. And along the way, we developed new partners. Where's Marty? Marty, thank you for the support of your bank and participating today. We're delighted to do business with you. And if you like it, we'll sign you up for the next 100 years. We'd be happy to do that as well. The title today is Where Are We Now? And why where are we now? Well, I don't know. Somebody thought it up and said, that's a clever, catchy thing. Little did we know, when we started a year ago and picked a date, we would wind up on the circumstances we see today. So I have a little opening handout, and I'll just ask the first 3 speakers, our panel, to come up and take 3 seats, and I'll introduce them in a minute, Bill and Kozo and John. And while they're coming up, let me talk to you about this handout. Where are we now? There are 2 pages. The first page, or page 2, is titled G7 Government Bond Yields. And there you have the G7 countries plus Switzerland. And you have the 2-year government bond yield. And as you can see, the highest of them is the United States at 0.7% interest. And the lowest is Switzerland at a negative rate of 1.1. Now, I would just say, if any of you would like to lend money to me for 2 years, and want to lend me $1,000, and I will be happy to repay you $995 at the end of 2 years. That's the notion of what things might be like in Switzerland. Next to it is a column of the 10-year sovereign yields, the same country, and what you see is the same. If you flip the page, page 3, what we've done to put this chart together is take the longest dated sovereign in each of these countries and put the interest rate there today, and the credit rating as well. Where are we now? 6 currencies, 24 countries, approximately 1/4 of the output, think of it as the GDP of the planet, is housed in those countries, is in a place where there's a jurisdictional negative interest rate as a part of policy. The other another fourth, is the United States, and we'll talk about that in a little bit, trying to get an interest rate up. And the other half of the world consists of countries and central banks which are lowering interest rates, easing, except for 3. And those 3, like South Africa, have decided to wait before they're going to raise an interest rate. We've just inventoried the whole globe very quickly, and that's where we are now. Some of these slides you're going to see today, Jill, are going to be on the DABE website and GIC website? Okay, and others are handouts. So a quick story and we'll get started with the first panel. Why do we, in this modern world, give out a handout? Everybody knows you're not supposed to do that anymore. Well, because some people like to write things down. I like to write things down, but some people like to write things down. So a quick story about writing things down, and we'll get started. There was a couple. They were together. They were in their 80s. They had been together for 60 years. And they were worried about the fact that they weren't remembering things. So jointly, they went to their physician and said, look, you know, we forget things from time to time. How about some examinations? Let us know where we are. So after some very thorough medical investigation, he sat both of them down. And he said, look, I don't see any evidence of Alzheimer's or any of the other characteristics that would suggest chronic disease. What I see is 2 people who've been together for 60 years, who are in their 80s, and when you're in the 80s, you forget things. So what I suggest you do, the doctor said, is when you go home, write it down. Take a little note, write it down, remember things, write it down. They did. They went home. That night, they're watching television. She starts to get up. Now, those of you who have reached a certain age understand what that means. You don't bound out of a chair. You get up. So she starts to get up, and he says, where are you going, dear? She says, I think I want to get a little ice cream. He says, I'll get it for you. And he gets up. And she says, vanilla ice cream. He says, okay, I'll get you vanilla ice cream. She says, remember you told the doctor you agreed you would write it down. He said, I don't have to write down vanilla ice cream. I'll go get you vanilla ice cream. I'll bring it right back. He starts towards the kitchen. She says, and when you're there, you know those strawberries in the refrigerator? Slice a few strawberries up, put it on top of the vanilla ice cream. He says, okay, strawberries on top of the vanilla ice cream. She says, write it down. He says, I don't have to write that down. At the kitchen door, she says, and there's some chocolate sauce in the fridge. A little chocolate sauce on top. He says, I got it. Vanilla ice cream, strawberries, sliced up, chocolate sauce. She says, you know, we promised we'd write it down. He says, I got it. There's all this banging, clanging, and racket in the kitchen. 20 minutes later, he comes out with a plate, hands it to her, bacon and eggs. She looks at him and she says, where's the toast? So we wanted to save some of you, and that's why we made copies of these handouts, and if you wish, you can also write it down. Let's get to this first panel and tell you what we're going to do. We have 3 members and friends of the Global Interdependence Center. They're all longtime friends of mine. We've worked together over the years. Real quick abbreviation, Bill Clark will go first. Bill has a distinguished career in the investment, management, policy making, directorship business. He ran the Division of Investments for the state of New Jersey back in the days when it could pay its bills on time. And for the last few years has been the Chief Investment Officer of a very small pension system known as the Federal Reserve's pension system. It's 20 billion?
22.
22 billion, the market went up yesterday. And following Bill and his view of where are we now and how do things look to him, Kozo Koide, a GIC member and friend of years, and the chief economist in the process of an organizational change, but currently and continuing to be, of the largest asset manager in Japan and maybe in Asia. And lastly, my partner John Musso, who we've been together for how many years? 16? 16 years. He's a director of fixed income and an executive VP of our firm. And you're going to hear 3 different presentations, 3 different market segments, and then we'll have time for a little Q&A, and that's how we're going to open our first round today. So without further ado, Bill Clark.
Good morning. As David said, I am a member of GIC, and I have to admit it's been a few years since I've been in an event, and I'm very glad that I'm back. Let me see if I get the slides. So I have to admit, I struggled with this presentation a little bit because, frankly, I think my views are probably pretty consensus around what I think of financial markets and interest rates in general. So I took a different approach and went more from a micro perspective, issues that are facing pension funds, although I think many of them face individual investors as well, and trying to draw some macro implications out of some very micro economic considerations. And I do have to say, Charles will keep me honest on this, the views I'm about to express are my own and not necessarily those of the Federal Reserve System, which in this case is true. So one would think that, and and this is the funded status of a typical pension fund that is measured by Towers Watson. And one would think, since the financial crisis, U.S. equities have gone up about 11, 12% a year on average, international a little bit less, that this would be a pretty good environment for pension funds. And actually, it's really been a pretty awful environment, mainly because we have liabilities, right? And those liabilities get discounted at a discount rate that's pegged to long-term corporate AA credit bonds. And that rate has gone down from 6% to 3.5% as of last week, right? And so when you think about the duration of your typical liabilities of a pension fund of around 15 to 16 years, you can sort of see that even with asset returns being as strong as they have, that really pension funds at best have been treading water, right? And when you think about what the prospects are for the future, the situation is really causing us to have to make some tough decisions. And obviously the other thing going on is people are living longer, right? So you've got to factor that into the analysis as well. And I would say, partly because of the decline in rates that David talked about, pension funds are grudgingly coming to accept that asset returns are going to be lower in the future. You can see that back in the late 90s, most funds were assuming something north of 9%. Say last year was about 6.8, and I would say this year it'll even be lower than that. So funds are accepting the fact that, one, bond returns are going to be lower. They have to be by definition. And also that equities and other risk assets, and we'll talk about this in a second, also are going to follow suit. And then you also think about, well, what are the prospects for growth going forward? And I think the general consensus is it's lower than it's been in the past. So what are my views? What are consensus views? And this first bullet really should have been at the bottom of the slide. But basically, future returns are going to be lower. Everything I look at out there, and I've got a few examples, looks fully valued at best relative to history. And I will say things look pretty reasonably valued relative to sovereign debt. Right? There actually are a couple of segments that one could argue might be a bit cheap. Right? But this is sort of a consensus view across all asset classes. And let me just give you a couple of examples. I'm going to skip this slide in the interest of time. So this is from KKR, private equity fund, that talks about a range of metrics of equity valuations in the U.S. And on average, for the overall index, we're in about 86th percentile. And if you look at the median stock, we're basically at 100th percentile. So equities, again, relative to history, looking at P ratios, price to book, whatever metric you want, look fully valued. But when you look at equities relative to treasuries, right, as measured by the equity risk premium, things look okay, right? One could argue maybe even a little bit cheap, right? So equities have clearly repriced to this new level of interest rates, right? So the risk premium itself looks fair, but what you're adding it to, mainly the risk-free rate, is basically kept up with the change in interest rates in the market. Similar story, credit. On the left is the investment-grade bonds, on the right is high yield. Pretty much the same story. The yellow line is the absolute level of rates. We're at record lows in both markets. But especially if you throw out the global financial crisis, spreads relative to those treasuries look okay. Nothing cheap by any measure, but about average. Real estate, similar story. Cap rates are kind of the way people measure value in terms of core real estate. Entry yield as on first-year cost or market value. We're at record lows in most segments, hotels being the one exception. But if you look at real estate cap rates relative to bonds, looks maybe a little bit rich. All right, some markets a little bit richer than others. San Francisco being one in particular that's really skyrocketed. But again, in general, a market that looks okay relative to treasuries, but rich relative to history. right? So the question then is, well, how do you think about, how do you invest going forward? And I'll talk about that in a second. If somebody asks me, well, what's the black swan, right? So I don't know about you, I hate having consensus views because I feel like I'm at a loss for understanding what's really happening. And the one black swan I could think about is the level of risk premium in assets is about there, right? The absolute equity risk premium. But when you compare that relative to the risk-free rate, the ratio is probably at record highs because risk-free rates are basically at zero, particularly real rates. So the question is there one more repricing of markets that's left ahead of us if the market believes that the risk-free rate is going to stay low forever, right? And I don't think that's going to happen, but if you ask me, well, what's the thing that could cause the consensus to go wrong, I would think that's it. And who knows, maybe that's what we're starting to see now as the market starts to price in lower rates for a much longer period of time than we even thought before. But again, that's not my call, and I don't think you can invest that way, but it is something to think about. So this environment of low returns, fully priced markets has really caused investors in general, I think the same is true for institutions, to really have two choices. And this is the first choice, is to basically say, I need a certain level of return, I'm going to increase the risk in my portfolio. All right? And you're seeing some do this, particularly state funds that almost have to do it. So this is a chart from Cowen Associates, a pension consulting firm, and the basic thrust is what kind of asset allocation at the lowest risk I can expect do I need to generate a 7.5% return, which is pretty similar to what most pension funds are assuming. And back in the late 90s, you could get that pretty much with bonds. And look at today, right? Your bond portfolio would have to shrink to about 12% of your assets, and there's this hodgepodge of alternative asset classes, public equities, international, EM, and look at the risk level that one has to accept to get that return. It goes from 4 to 15% in terms of standard deviation, right? So that's one option. The other option, I refer to the paradox of thrift here, is people have to save more. And when you think about long-term retirement readiness and preparation, this chart I did a couple years ago, but I think it's still valid. And we talk about a typical pension plan. It's our plan, right? So I just calculated, I said, assume somebody 35 years old starts at the Federal Reserve, gets a modest increase every year, retires at age 60, right, and then takes out benefits according to the benefit formula in our plan, and they live as long as the actuaries say that they're going to live, 85 or whatever the number is. What constant level of investment earnings do I need to get during the accumulation period and even the spend-down period in order to fund that projected benefit, right? And you can see this is the mother of all convexity for the bond guys out there, right? As the investment return gets lower, the amount that people need to save skyrockets. And I think you're starting to see this in the individual savings rate going on. And you know, this is really scary when you think about retirement readiness for our population. And I think the thing that causes me to question is, are low rates really having almost a perverse incentive and actually causing lower consumer spending rather than higher consumer spending? Particularly when you think about baby boomers getting into their prime savings years. I think there's something to that. So let me wrap up by talking about, well, what are pension funds doing? And again, you can almost insert individuals into the title because it's pretty much the same thing. And it's something I'm baffled by, quite frankly, because you're really seeing some funds going the aggressive route, and we'll talk about how they're implementing that. Some going the conservative route, saying, I can't get high investment returns no matter what I do, so let me at least worry about protecting against the downside. And then you've got some funds that are doing a bit of both, right? They're saying, for some portion of our assets, I'm going to lower my risk profile and try to lock in a certain portion of the benefit stream. And with another portion of my assets, I'm going to increase risk and do some other things to generate extra return. All right, but I think each of these items has some implications that you have to think about. So let's talk about pension funds and the movement into alternative investments. And you can see that pension funds in general now are about 22% in alternative assets, as I'll define them broadly, hedge funds, private equity, and the other. And the argument here is that you give your manager more flexibility, more tools in the toolkit to try to generate returns that are somewhat uncorrelated with the overall market. Now, hedge funds have gotten into some issues, and you've seen some big high-profile pension funds actually decide to pull out of the hedge fund asset class. And I talk about that in a second as to one of the implications, or one of the possible reasons for hedge funds underperforming. But one of the things that scares me about this, and there are many, you're starting to see individuals move into alternative assets. Right? I was just literally this morning watching CNBC, and Invesco has an ad out that the 50-30-20 is now the new 60-40, recommending that individuals put 20% of their assets into alternative investments. It's like these. And I'm just not sure that as a country or as an investor class, individuals have the staying power or the skills to really invest these kind of funds properly. But this is one of the factors that is, low returns are one of the factors that are causing participants and plans to pursue it. So in particular, private equity. So what's the fascination? So if you look on the left, right, even adjusted for leverage, these numbers are not adjusted for leverage. The data show that private equity as a group has generated 300 to 500 basis points of excess return, which sounds attractive, and it's been pretty sustainable. And you can see on the right the growth in assets, mostly from institutions, although you're starting to see some individuals as well. And to the point where now private assets, if you include so-called dry powder, monies that private equity funds have at their disposal to invest, now is about 10% of the public markets. Right? So all of a sudden, private equity has a bigger influence on what's happening in the public markets, right? And is really almost a factor that's trying to instill market efficiency going forward, right? And the question is, can private equity that returned 300 to 500 basis points when they were about 2% of overall equity assets do the same when they're about 10? And these are some of the factors or the theory behind why private equity can generate returns. And the one I want to focus on is the operational improvements. You see private equity firms out there now that have their own independent consulting firms that just go into these companies that they buy to try to improve margins, improve revenues, things like that. Right, so the theory is this is almost active management on steroids, right, to try to generate excess returns, and it's one strategy that funds are finding attractive. Oops, I missed one. The second is they're trying to take advantage of what is perceived to be an illiquidity premium in the market. That if I'm willing to tie up my money for a certain number of years, right, and give up the liquidity, a la a financial institution or a bank might do on a long-term direct loan, there's extra returns available to me as an investor. And this is the spread or the rates available on direct loans versus traded loans, so-called levered loans, bank loans that trade in the secondary market. And there's about a 2 to 250 basis point premium, right? So it sounds attractive, particularly a pension fund, right? Our liabilities are very predictable. The thing I think we have to think about, though, is, in essence, institutional investors are coming in and taking the place of institutions like banks and insurance companies, right? And all of a sudden, we're now a lot more important to the integrity and the the robustness of the economy, and what happens systemically if institutions decide to back out of this market, right? Just an unintended consequence of Dodd-Frank and regulation, one that's had a positive effect or reduced some of the negative effects, but one that I think we have to be concerned about. And what's happening, this is an illiquidity index that Towers publishes, right? This premium that investors think is available is starting to shrink, right? As more capital flows into those types of assets. Now on the conservative side, right? If one believes that returns are going to be lower going forward, investment fees, management fees, all of a sudden become a much bigger portion of those returns, which is driving funds to try to reduce them in any way possible. So these are mutual funds only, and we've had about $1.1 trillion of inflows into index funds, equity and bonds, although primarily equity, since 2007. Right? And conversely, $1 billion out of active equity funds, including hedge funds, right? So when you think about why are active managers and hedge funds underperforming, you can almost think about, well, if the flows of capital are going out of the stocks that are owned by active managers and into the index that includes all the stocks, those active managers by definition have to underperform. And I think that's part of what's happening, and there's a lot more that can go. And this chart blew me away. So we're a client of Vanguard. This is public, though. So Vanguard last year, right, which is primarily an index shop, had inflows of $256 billion. All other mutual fund companies combined had outflows of 85. Right? So when you think about, well, all right, 15 to 20% of assets are managed passively, that's one thing. But when you think about the flows, right, into ETFs and mutual funds that are passively managed and the flows out of active managers, you have to think about what is that doing to people's stock portfolios. And I think you're starting to see it in some of the results. The next is, this is sometimes referred to as smart beta. I hate the term, so I didn't use it. All right, but essentially, individuals are looking to their equity exposure, and they're focused on getting more income, right? Which is why utilities, consumer staples, certain healthcare names are doing as well as they are. But this is just the spread here is immense. So this is just year to date. The so-called dividend aristocrats index. So these are stocks that have grown dividends consistently for 20 years or more. All right, these are supposed to be the low-risk stocks in most people's portfolios. And just look at the outperformance. 700 on the Russell, it's about 1,500 basis points in 6 months. Right? So clearly, investors are looking for income. They're looking to lower the risk level of their equity portfolio and try to make as much of that return as certain as possible. And again, you think about, well, what are the implications, right? So the chart on the right is the Merrill Lynch Mutual Fund Manager Survey, right? Which shows if you ask your typical stock picker, right, they're saying they want companies to spend on CapEx, right, to grow their businesses. Well, what are companies doing, which is the chart on the left? Well, they're actually responding to what investors want. So you look at the free cash flow relative to dividends and buybacks. We're at record highs, right? So companies are looking through to the asset allocators rather than the stock pickers, right? But when you think about what does this do to CapEx in the economy, long-term growth, it's not certainly not positive, right? But it's another distortion, also almost resulting from low rates. And then this is, I'm just going to skip the next slide. This is something, I call this the alcoholic's pledge to stop drinking tomorrow. So companies are saying, I want to lower the risk level of my portfolio, right? But I don't want to lock in rates today. Right? So what I'm doing is I'm going to build into my pension policy statement that if I get to certain funding levels, presumably because interest rates go up and my liabilities go down, I'm going to switch out of stocks and into bonds, right, to try to lock in some higher returns, right? And I would say about 80 to 90% of corporate plans out there have this hard-coded into their investment policy statements, right? Which sort of makes sense, right? So if rates ever go back up again, I'm going to do what I should have done back in 2000 or 2007 with the corporate bonds, right? But what are the implications? Well, my view is the yield curve is going to stay flatter for much longer than anybody thinks if you believe that this flow of capital is going to go into the long-term bond market as rates rise, which I believe would. And then the last, and I'll just go do this real quickly over and wrap up. You're also starting to see a pension risk transfer market develop. Right? So company plans are going to Prudential, they're going to MetLife, and they're saying, I don't want to pay PBGC premiums anymore. I don't want this earnings volatility from my pension fund. I'm going to give you a pile of money or a pile of assets, and you take the liabilities off my hands. Right? And I remember back in 2012, 2013, Verizon and General Motors did this, and everybody thought they were nuts. Right? And now they look really smart. So the question is, how much more of this activity will you see? Right? And then the other question, when you think about what's a SIFI, right? MetLife got off as from being considered a SIFI, but if you transfer $2 trillion of corporate plan assets off the corporate books onto MetLife and Prudential's books, try thinking about whether they're a SIFI at that point. Right? I suspect you may have some very different conclusions. So in conclusions, if one accepts that we're in a lower term world, we all need to save more, and individuals are, and pension funds are funding more. By being a liquidity provider, taking advantage of some of these spreads, all of a sudden institutional investors become a lot more important to the integrity of the financial system. Are there systemic implications for that? Flows into passive strategy make it more difficult for active managers to outperform. It almost becomes a self-fulfilling prophecy. An investor's appetite for income is causing corporations to change their behavior that I would argue in the long run is actually negative for economic growth, although it may be very positive for their stock price. And then finally, de-risking activities by pensions will cause the yield curve to be flatter. Right? All of these, I'm sure, I think you're seeing play out, but I'm sure no one ever really would have thought some of these would be the fallout for where we are. But frankly, I see this continuing for years to come. Dave?
Bill, thank you. Thank you, Bill. What we'll try to do is in the economy of time, we'll do all three presentations because we want to make sure everyone gets to hear the presentation. And then we will do a Q&A that'll be rapid fire, freewheeling at the end of the session. So the second presentation is Kozo Koide. Kozo, please.
Thank you very much. This part is supposed to be taken by our colleague Mike Drury. He is a professional of Chinese economy for years, but he asked me to take his part. But I am basically the Tokyo-based economist, so therefore my part is designed for describing something about the Japanese economy with a brief comment upon Asian countries, including China. But before beginning opening the charts and graphs, today's one of the theme is the possible impact caused by the Brexit. So therefore, let me introduce briefly about the presumed impact caused by the Brexit. Maybe there are three channels to get impact upon Japanese economy from the Brexit. First, the trade. How much Japanese trade rely on final demand of the United Kingdom? My point is whether the Japanese parts and devices exported to China, assembled in Shanghai, we export to China, UK, even if directly the Japanese export destination is Shanghai, but eventually that export is linked to as a final demand in the UK. We have this kind of table organized by the WTO as of 2013. If you calculate this data, how much export really rely on final demand in the UK vis-a-vis nominal GDP is only 0.2%. United States 0.5%, a little bit higher, and 0.6% in China. In Asian countries, 0.9% of the Singapore and Hong Kong and Taiwanese economy share is 1.1%. Of course, in Europe, it is much higher, led by the island economy, Irish economy, the percentage of the real dependence to the final demand there is 6.4%, followed by the mother and Cyprus. Minimal to Japan, direct channel from trade. But the second point is direct investment. In 2013, the latest authorized data, the destination of the UK as a direct investment from Japan to outside is number 4. US, China, Singapore, and UK. But this year, for sure, the UK will move up to the second, and China will drop to the third. Majority of the investment is generated by the car manufacturing, Nissan, Toyota, and Honda. But besides, recently Hitachi did a huge investment there to open the facility of the train, and they have been using this facility as a hub center for export to all of the other EU countries. I did not check out the tax rate, the custom tax rate on the train under the WTO rule. But remember that the highest custom rule under the WTO, if the privilege of the free trade of the UK enjoining to access a single market, EU will be totally ripped off. The most damaged area is the food industry, 22%, the 10% for the car manufacturing, and 5% for car parts. So the Nissan, Toyota, and Honda really worry about this kind of possible legislative change in the future, but not instant impact. It takes about 2 years, and if they would like to establish some free trade agreement, maybe possibly that would take 5-6 years. The last one is much more serious one. The impact upon the risk premium in the asset market. There was, of course, you remember, right after the unexpected outcome of the voting, suddenly the yen appreciated sharply after the 99 zone. Almost always, when there is a very bad, unexpected thing happen in the world, the yen, together with the Swiss franc, is a favored popular currency as a safe harbor. So that is a much more a serious issue. So therefore, in the near term, maybe the Japanese authorities think about the Japanese yen against other major currency, the appreciated side. That's my wrap up about the Brexit. But in the near term, there's no measurable change in GDP. GDP, not encouraging, hovering around 0%, and maybe the third quarter's GDP is lower. You saw the contribution by composite, but the export, consumption rate one, hovering around 0, and also this is the export week, and almost no support from the capital expenditure. So therefore, I would like to check out the background why the economy was not so good as expected. First, yen swing back dramatically, but on the other hand, the volume of export hovering around the same level. I just put the some work. Suppose if the elasticity or sensitivity of Japanese export vis-a-vis marginal change of exchange rate stayed at the same level before the Lehman crisis, and suppose if elasticity of Japanese export vis-a-vis the global economy stays at the same level before the Lehman crisis, our export volume should have traced this blue line. And this is a real one. The gap between the two is almost 50%. So therefore, if we just reserve the exporting facility, manufacturing facility for the exporting goods, like the style before the Lehman crisis, our economy should have enjoyed a big boom supported by the export, not this time, because we already allocate a lot of facility after the Lehman shock, and we have a huge earthquake in March in 2011, so therefore we just diversified a lot of facility out of Japan, mostly toward Asia. So therefore there is no easy way back from Asia once they hollow out because of the huge sunk cost. The second point is capital expenditure. The green line shows the expected return on asset. I calculate the gap between the average return on asset and weighted average cost of capital. From 2000 to 2008, I can explain the year-on-year change of the Japanese capital expenditure by this green line more than 50%. But after the Lehman shock, the relationship between the two just get lowered, and also after the earthquake, much lower. So therefore, even if the expected return from the additional investment is climbed up to the highest level in history, but the corporation hesitate to use their money for capacity enhancement. Maybe shut down the nuclear reactor is their worry. Tax regime, there is no major change. Already the other governments take some step ahead, cut the effective corporate exchange rate, a little bit lower than that in the United States. And the delay of the free trade agreement told the TPP. My friend working for the Foreign Service Office pretty much disappointed at the current political situation in the United States. Both the candidates clearly announced that we don't want to endorse the TPP agreement in the next government. And some cost is also very big. So there's not easy way back to Japanese airlines once they invested huge money in the last 4 or 5 years. Lastly, consumption. We have a little bit unique data about the personal consumption. Here, just decomposed into the different 5 income class quintile decomposition. First quintile means the lowest 20% of the income class. And fifth quintile means the top 20% of income class. This is the data of the employed person. Blue part, there's a thin, light blue and a thick blue, both two indicate the contribution of the lower 40% of income class to push down the Japanese consumption after the VAT hike. Everyone would rush to buy the expensive commodities such as the car or watch or TV. There's a reaction. But the stagnation of these lower income people just prolonged more than expected. And because of the demographic change, 73% of this lower 40 income class people is basically retired person, elder than 60 years old. So therefore, elder than 60 years old, basically their life is supported by the defined benefit pension system. So therefore, they are unhappy to look at the moderate sustainable inflation. So therefore, if the demographic profile stays at the same level as of the year 1990, the Japanese economy was much easier to lift it up. These are the 3 major components why not performed well as expected, but one by one, maybe there is some positive change going on. First, start with the export. Even if for the Japanese exporters it's difficult to just shut down the recent open advanced facility in China or go back to Japan, but they are gradually changing their commodity mix up to the much more high value added expensive one. We have the 2 different unit export price system. One is quality adjusted one. The BOJ is monitoring on the same commodity a mix as of 2010. The other one is gauged by the Minister of Finance. There is no quality adjusting. So therefore gap, the inflation gap between the two is a kind of proxy to analyze the change of the quality or value added per unit. This is just began to soar again. So therefore what they are doing is they do not rely on the simple expansion of the export volume supported by the cheap yen. Rather, they would like to change their commodity mix, much more higher commodity not to be manufactured in the Asian transplant. That will help the Japanese exportable volume will to be reconnected to the global economy gradually. And the capital expenditure plan, not too bad, even if there is a very bad news happened outside to begin with the Brexit. But so far, the investment plan as of this fiscal year is not too bad, not too good, not here, but not too good, hovering around the same level regardless of some unexpected, unfriendly business environment. And partly because this resiliency is supported by the new corporate governance code set by the Japanese government. Now, I am one of the institutional investors, but more and more the government authority requires us to check out about the efficient use of the capital of the company where we put the money. And lastly, the demography. This green bar is a marginal change of the labor participation rate since the bottom of the current business cycle. This is, I'm sorry, the red one. Red bar is a change of the participation rate. And the green bar is the marginal supply or decrease of labor. Centered in the woman, middle of the woman, labor participation rate has jumped, but because the demography is changing, so therefore the size of the population of middle age just has been shrinking. So therefore, even if we have a higher participation rate, but the labor supply from middle age is going down. But on the other hand, here, elder than 65 years old, the largest labor supply is the generation coming from the generation elder than 65 years old. I'm at 57 years old. Up until recently, the retirement age is 60, but the government extended the retirement age literally to 65. And I would like to come back the probability of the deflation and inflation story, GDP gap. My argument is maybe the Japanese economy already get out from the deflation and be inflated slightly. The US type CPI core last year is 0.7%, not negative anymore. And here I indicate the diffusion index of capacity and labor. Diffusion index means the companies who think that we have the excess capacity minus the number of the company who says we have the shortage of the capital. So therefore, gap between the two is a proxy of the demand supply situation of the stock of the capital and labor. And the labor diffusion index is here. So therefore, we are suffered by the most serious labor shortage since the fourth quarter of 1988 in the middle of financial crisis. And even if I said a lot of manufacturers shift away from Japan, that the diffusion index almost come down to zero. So therefore, in total, there is no capital slack. No capital slack and the serious labor shortage, that suggests that we have no deflation gap anymore. So therefore, Japanese potential growth maybe at the right now the 0.5% by the government estimation. My estimation is 0.3, the BOJ's estimation is 0.2, range from the 0 to 0 to 5. So that means if there's no deflation gap, accumulated slack of the capital and labor, 0.5 to 1% very slow economic growth is enough to invite the sustainable inflation pressure. Then everyone everyone is a little bit frustrated by the slow move of the Japanese economy. But the Abe government, what the Abe government would like to try and they would like to see is some sudden behavior change of the corporations, household investors. Once they get out of the deflation, long lasted for 2 decades, and get into the inflation, maybe there should be some non-linear change in the behavior. This is one of the examples. This charts I have been waiting for in the last 2 decades' time as an economist. This is a propensity to consume. How much money the Japanese household using out of their disposable income. There's a huge spike. We saw this spike 1 month before the recent VAT hike. Let me introduce, maybe in my time here is limited, but let me introduce my personal episode. My daughter, born in 1991, never ever experienced what the inflation is all about. She understands the price is always go down. So therefore, every time I ask her, what kind of present would you like to have in the next present, her behavior is told me the day before Christmas time. So therefore, it is the best way to get the best price. But for the first time, last December, she asked me that, Father, could you buy this one for the next Christmas? 2 weeks before. I was shocked. This is a behavior change. So once economy is just growing, to have the slight inflation, to expect some sustainable inflation of the price in the future, maybe that kind of behavior shift can happen. But after that, just go dive again. And as you already told, partly because of demographic change, and partly because Japanese management slashed the summertime bonus after the VAT hike much. So therefore, after the VAT hike, annual total wage decrease very much in the employed person, even in the top 20% of the income class. So therefore, they go back. But we are just waiting for this kind of thing, behavior change. Then, 1 minute. Negative, maybe I can invite a question from you. It is a very bizarre agenda, negative interest. Just David illustrate briefly, but things now happening is the central bank put negative interest rate in a limited portion of reserve deposit. So bank suffered by exposed to the negative interest rate in the reserve deposit, but that extra burden of the Japanese bank has not been passed through the clients. The clients deposit positive. Then it is nothing but the taxation upon the banking industry. So the bank is now suffered by the additional cost. And this is the yield curve, nicely, softly, gradually going down. Now we have the negative interest rate up to the 10 years horizon. Sounds strange, but please be careful. If there is a money manager sitting here, the market structure is totally different. To begin with, what kind of people continue to buy the negative interest rate? Note, here, short-term zone, there is only 3 players as far as I know. One is DOJ, the other is a broker, and last one is foreign investors. The foreign investors continue to buy the JGB short-term duration zone, even if the yield is negative, because of the rate hike of the United States. Everyone would like to have a dollar liquidity. There's a shortage of dollar liquidity, so therefore we call it the swap, basis swap between the dollar and yen expanded this much. So therefore, the foreign, for example, JP Morgan lend the money to the Japanese banks. Their funding cost is deep negative in yen. So therefore, they can just enjoy the spread between the deep negative funding rate in yen and this minus return. So therefore, this is one of the reasons, a distortion caused by the choke of the liquidity in short-term dollar. Maybe I should stop this. There is some charts of China, but maybe one comment about the Asia. I'm sorry, David. because there is a lot of maybe the business in the real estate, Main Street attended here, so therefore this is one of the caveat. When I attended the OECD office in Paris 2 years ago, I had a discussion with one other person dispatched from the Japanese government. He said at the beginning, he worried that everyone in Tokyo is are not so conscious about the possible financial crisis in the future in Asia, because Asian country has grown. They have a lot of current account surplus in case, and the accumulated foreign reserve account is ample. Don't worry about that. There's not a situation like the late 1980s when we caused the currency crisis, sovereign debt crisis in Asia. But the point is, this time around the crisis, risk is accumulated not in the sovereign balance sheet, but the corporate balance sheet. This is the credit to non-financial cooperation vis-a-vis nominal GDP. Our countries is this, the peak was 1994, after the Barca bubble going down, but Asian countries, this is Asian crisis here, this is up and down after the crisis going down, this is China, this is Hong Kong, this is Singapore. So there is some excessive extension of corporate leverage. And also, please give about the Indonesia, for example, the ratio is low, but they are having a very serious asset liability mismatch. 90% of the sales in the Indonesian company denominated in Indonesian rupee. On the other hand, slightly more than 50% of the corporate debt is denominated in dollar. And also, they borrow the short-term dollar money for long-term something. So therefore, duration mismatch and currency mismatch is there. So therefore, it is one of the tail risk thing in foreseeable future. So therefore, Asia is a promised country, but when we are now getting into some unexpected, uncharted world, a lot of uncertainty there. Maybe this is one of the points we should look at. Thank you very much. Time has run out.
Thank you. What we're going to do, because if you see, we have covered the G7 and world in 2 minutes, negative rates. Bill Clark with options and structural changes in asset allocation in 15 minutes. Kozo, the entirety of Asia in less than 20 minutes. And we have a $3.7 trillion U.S. asset class in state and local government debt. John Musso will talk about it and try to condense time. We'll extend the session then for some very rapid fire Q&A. So please think about what you want to ask. It'll come quickly. I'm an offensive master of ceremonies, and so you'll have 20 seconds to direct the question. No alternative speeches, please. And we'll ask Charlie Plosser to wait about 5 more minutes before we hear his keynote so we can get it in. John, please.
All right, thanks, David. And I will try to speed things up here a little bit. And there's a few charts I'm going to skip that are more broadly based on interest rates, just because a lot of it's been covered by Kozo as well as Bill. I thought it was interesting how Kozo ended and talked about negative interest rates. We don't expect negative interest rates here in the U.S., but I've already had clients ask us if there's such a thing as a negative investment management fee. And I told them to talk it over with the boss. A little bit of pushing. David and I and another colleague published a book last year, Adventures in Muniland, and it was really to kind of capture the crises that have gone on in state and local governments since the financial crisis, since nobody else did it, so shameless plug there. The idea of looking at where we are now, you almost have to go back 9 years plus to get what we would call normalcy. And when I say normalcy, I mean a state and local tax-exempt bond market that was priced normally, which means priced at a decent level below the U.S. Treasury curve. You pay taxes on treasuries, you don't on municipals. And you have to go back to basically January of '07. And you have a AAA municipal bond yield curve, and you have a U.S. Treasury curve substantially above that, and of course, here's the taxable equivalent grossed up for the top tax rate. Just a year and a half later, not even, 2 years later, in 09, and actually this is actually a wrong date, it should be December 29th of 08, you can see the things were all upside down. You had U.S. Treasuries have been bid down. The world didn't want to own anything but a treasury. Here you had AAA municipals, a lot of AA and single A municipals were well above 6%. Corporates were being given away here. Here's the top tax rate. So just, this was the world upside down, and we capitalized on that. Here's the last time you got close to normal was January of 13, and you can see, for the most part, most top-level municipal credits were below treasuries. But once you get into the A's and double A's and the more generic municipal bonds, they were still cheaper than treasuries. So it was close to normal, but not really normal. And here we are now, and we made great strides towards normalcy this year, and then Brexit happened, and we saw U.S. Treasury rates gallop from essentially 2.5 all the way down to about a 2.10, and they're back to about a 2.25 on the long end now. But it has been a lot of progress for the municipal bond market over the last year. When you can think about that, a year ago and change, or just a year ago now, you were buying municipal bonds at 4%, and now a long municipal bond might yield you, 2.5 to 260. I mean, it has been quite the trip. This is where we compare the long bond buyer 40 to the U.S. Treasury. It has been, if you took this graph back and took it back about 50 years, it would almost always look green, because most of the time you had tax-free bonds yielding you something less than treasuries. It's been obviously supremely abnormal since. Here was the late 08 period, and gradually we've started to get back to some degree of normalcy. We think that as the Fed gets back to raising short-term interest rates, and obviously they're on hold right now with Brexit, that you will continue to see municipal debt in this country priced lower than Treasury debt. It will get there. And obviously a lot of this is the fact that Treasury debt is priced at probably yields that are extremely too low rather than munis being too high. A little bit about some of the trials and tribulations of the municipal bond market. Here's the 08 financial crisis. Here's Meredith Whitney. If you guys remember back in 2011, she said that there would be hundreds of billions of dollars of municipal defaults in 2011. She gave that in a 60 Minutes interview in December of 2010. It didn't happen, but it didn't stop all the outflows from happening. Here's the taper tantrum, bond funds selling, which was actually worse than Meredith Whitney, because in really one of the only times in 30 years of managing money we were seeing bond yields increasing at an increasing rate. That doesn't happen very often, and it is not a fun market to live through, but it does present great investing opportunities just because people are throwing bonds over the side. Here's the long trip down in yields. And you can go back to the books now, and you cannot find municipal bond yields this low in history. So from the extent of being opportunistic for issuers, it is the time. And you are seeing municipal bond issuers come to market not only refinancing bonds that are callable now, and they did a lot of that last year, but now you're seeing them do many, many advanced refundings. We were talking a little bit about with Jack Blumenthal last night about refundings, and this is the heyday, and you'll see in the supply chart in a minute how much of that is refundings. Bond fund flows. This has been the bane of our existence. Here's the Meredith Whitney bond fund outflows. Here's the taper tantrum bond fund outflows. And it took a while, and they really didn't pick up much until recently. And in the last few months, you've seen about $23 billion of municipal bond fund inflows. And that has been some of the cause, with rates rushing down as much as they have in the last few months. No doubt some of this was spurred on by the fact that earlier in the year, people remember in January the volatility in the stock market. Seems like a long time ago now, but there were some pretty dreadful days. And there's no question in our mind, at the beginning of the year, there was some reallocation out of equities into bonds, and particularly into municipal bonds, and the bond fund inflows have kept up. This worries me a little bit because the market did repair itself without the participation much of the bond funds, and now that they've come in vigorously, you wonder is there a spark that chases them out? So if there's something that keeps me up at night a little bit, that's it. Here's supply. Over here, you can see it's really picked up in the last few months, and this is all issuers coming to market to refund in advance older, higher coupon bonds. Last year, you had a record first half of issuance. In fact, through 6 months last year, through June of last year, you were higher than this number here, I believe. We're right on it, and it was pointing towards a record year. It slowed down as you got to the second part of the year, mainly because a lot of these bonds that were callable had been called in, and new bonds issued. This is why we don't think a Fed rate hike is going to be particularly bad for intermediate and longer bonds in general and municipal bonds in particular. If you went back to the last rate hike where they went from 1% to 5% on Fed funds, with every meeting ad nauseum being a quarter point, 10-year and 30-year U.S. Treasury bonds only went up about 85 and 75 basis points respectively. They were a little ahead of the Fed's work. So the yield curve obviously flattened a lot, with short-term rates going up 400 basis points, but the intermediate and longer end less than 1%. But more importantly, that muni Treasury yield ratio, which obviously got to 130% last year, which was a bargain when you could buy long munis at 4 and the U.S. Treasury was at 3. That ratio, the last time the Fed raised rates, actually went down from about 103% to 85%. And if you think about it, that's common sense, right? If you raise Treasury yields 100 basis points, you really only should have to raise municipal yields 60 to 75, 80% of that because of the tax exemption. Let's skip through a little of the Fed stuff and just kind of get where we are now. Federal deficit. We can see that you had $1.4 trillion right after the last election. And what's happened since then? Well, we know that sequestration has obviously slowed down government spending, and the rise in marginal tax rate has increased revenues, and that's dropped. And if you see where we are now, it's starting to flatten out a little bit. We sit here and wonder, this is attractive for somebody like a Donald Trump, who might walk in if he gets close in the election or if he gets elected and say, you know what? We went from basically $1.4 trillion down to the 0.4. Let's sell $1 trillion worth of U.S. government long-term inflation index bonds, maybe 50 or 100-year bonds, non-callable, and put it into infrastructure. So think about an $8 billion Manhattan to New Jersey tunnel that hasn't gotten started yet and keeps going up price. Here's $4 billion, you guys raise the other $4 billion. Florida just became the third most populous state in the union. The roads need lots of work. Got a $2 billion program, here's $1 billion, you raise the other $1 billion. Something like that would, in our eyes, be probably pretty good for the economy, number one. And you'd probably see bond rates go up 100 basis points, in a heartbeat. So that's something else that keeps you up a little bit at night. Quickly on muni credit. One of the reasons why in our own taxable bonds, IRAs, KIOs, foundations, we have lots of taxable munis, and when they're priced wrong, even tax-exempt munis in those portfolios, is because of the credit quality. This shows you the distribution of ratings between municipal issuers and corporate issuers a couple of years ago. It hasn't changed much now. And you can see the average municipal issuer has a much higher degree of credit quality. And that means a lot to us, and particularly because we can buy taxable munis at spreads that are actually wider often than corporates. And as we'll see in a second, present a very, very compelling case for credit so that you're basically getting more yield and get better credit quality at the same time. This is a Moody's study, which they are just updating this now for this year, 2016. They update it every 2 years. And it shows the cumulative default rates on this class, municipals, over a 10-year period. So if you see where they start out and you go out 10 years, obviously a AAA has no default risk pretty much. You get down to even something like investment grade, BAA, and still 10 years out, the cumulative default risk is less than half of 1%, 0.37. Now, it isn't bad on the corporate side, but the difference on a percentage basis versus munis is stark. Let's look at this. A BAA corporate is a 441, 10 years out. That's not a lot, except it's, almost, 40 times what the municipal default rate is. So in our eyes, we think that the municipal credit has really been undervalued for a long time and still is. A little bit about Puerto Rico, and then I'll close. In our shop, we have a separately managed account style which invests only in insured Puerto Rico paper. We believe in the 2 bond insurers that insure most of it. But what's interesting is comparing what happens as you get a problem in Puerto Rico. And you'll have one more chart I'll show you. Yields start to climb up, and they continue to climb. But look at the insured bonds got trashed just like the uninsured bonds. So the idea is that headline risk, which we vigorously analyze bonds to guard against, is what really hurts munis. It's when it's on the front page, whether you're talking about Chicago, whether you're talking about Harrisburg, when you're talking about Puerto Rico. And once it's on the front page, the liquidity, for the most part, is impaired. This is where you had great value, and obviously yields have come down significantly on the insured paper and still climbed on the uninsured. In the last chart, this is the bellwether bond of 2035. Should have had age of 35. Look at this. Came out in March 2014. They sank $3.5 billion. Every hedge fund in the world was in on it. They aged at 93 cents on the dollar to yield at 8.75. And this was all with the promises. We're going to have more liquid. We're going to have more transparency, better communication, ongoing updates on the island, and nothing. And here we are today, and we know what happened. We had a bankruptcy on July 1st of the general obligations. The U.S. government is now involved, and you're going to see restructuring going on in Puerto Rico. The real question for us is there a risk to a carryover in states like Illinois? Say, hey, what are you going to do for us? And we're studying that now. And I'm going to stop there.
Thank you, John. We're going to do some very rapid questions. Just a point to be made. Hedge funds bought the 8.5 coupon issue, $3.5 billion issue by Puerto Rico, tax-free. And we've observed some of those hedge funds are held by charitable foundations and pension systems. When you digest that, you begin to think about opacity versus transparency in the investing climate when Bill Clark has pointed out how you are expanding alternatives to traditional securities. So with that note, let's do some very quick questions. Sir.
Kozo, a question for Kozo. Were you surprised by China's elimination of the one-child-only policy? And was that as much a measure of a discussion about scarcity of resources or scarcity of workforce?
There's a switch on the top, Kozo. You can just turn it on, go right into the microphone.
Well, our country began to talk about the future demographic issue way back to the first half of 1980s, but there's not a measurable change. Now we have suffered a demographic change. Having said that, in China case, two things I would like to tell you. Every country in the world, when they women's salary go up. The effective fertility rate tends to go down regardless of the government support anywhere. When I attended the Taiwanese government, the director of a pension system told me, a little bit controversial to introduce her personal comment to me, but she said maybe really fertility rate here in Taiwan is below 1, although the official rate is a little bit higher. The Taiwan and Korea's fertility rate is lowest in the world. So therefore, maybe it's a little bit too late to change the policy. In China, the woman's position in labor market is very strong, almost equal. So therefore, if there is no child care supporting system systematically, it's not a decisive measure to lift up the fertility rate. That's my observation. It is too late. And even if there is some change, we will see some change in the next 25 years or 20 years.
Thank you, Mark.
Yeah, Bill, I was just kind of wondering, you talked about the pension funds having to adjust to the lower growth deal, but one thing I still don't hear much of is, are they changing the, as part of the requirements for the retirees? Because it's not easy to do that. Are you starting to see that? I mean, they have to do it, but it's not.
So yeah, I think
There's a switch on the top of the microphone.
I think is it on? Yeah. I think you have to break it up in between corporate plans and the publics, right? So I'd say the vast majority of corporate plans have closed new accruals. So they're frozen plans, right? So any benefits that folks have earned will be paid, but people are not accruing new benefits. It's very rare that you see an open plan. The state and locals, there's a lot of political debate and legal arguments. Minnesota tried doing it. New Jersey did it. Actually, theirs was upheld. So you're starting to see this happen, but most of the changes are to new employees, which really does not make much of a dent. I mean, I look at my state. I mean, there was a lot of talk, but when you really look at the impact on just new employees, it doesn't really make a dent. So I think politically, it's just going to be really tough for states to do it. And even if there's the will, then there's the legal impediments to trying.
Any other questions? One more, last one, sir.
This is also for you, Bill. I'd like your opinion on what you think the real assumption rate should be for pension funds. I just read recently BlackRock came out with a 60-40 projection over the next 5 years of 3.5%. Where do you stand personally, what the number actually ought to be?
That seems a bit low, but it seems a lot closer to reality than the 7 to 8 that folks are assuming now, particularly on the public fund side, where they actually discount the liabilities based upon the assumed investment return. Corporate plans and plans like ours discount based on corporate bond rates. It's really an impact, but I think that sounds a bit low. I mean, you can get on a long bond portfolio with some credit exposure, something in the almost 4%. So 3.5 sounds a bit low, but 7.5 to 8 sounds a bit high, more than a bit high.
Shall we thank this panel? They packed a lot of information. Thank you. We're going to immediately go to the next session. And while the panel packs up, let me introduce a good friend who was the dean of the Simon School at Rochester, where things were calm. And then if you noticed that chart, he joined the Federal Reserve as the president of the Federal Reserve Bank of Philadelphia, member of the Federal Open Market Committee, and a policymaker in 2006. So if you really want to know why we have been through things for the last 9 years was Charlie Blossom's fault. And now, after his period of time with the Federal Reserve, Charlie is now a public member. Am I saying it correctly, Charlie? A FINRA. A distinguished career in economics and in policy making, and a very good friend. And we're delighted to have him, one, as a Global Interdependence Center supporter and member. He's received the Global Citizen Award and continues to comment on various aspects of economics and monetary policy throughout the country. And so please welcome Charles Blossom.
So David, thank you very much. It's a pleasure to be here, be back in Denver in the Mile High City. It's exciting. I haven't been here in a while. I passed through a number of times. But I'm also proud to say that I'm about to become at least a part-time resident of Colorado. So I'm really excited about that. So I'm pleased to be here. You know, it's also delightful to be here and be invited back to another GIC event. I've been a frequent participant and attender of GIC events for nearly a decade now, I guess. And as always, they assemble a great group of people to foster a dialogue. And I think this meeting is an example of the types of people that come together and deeply consistent with the sort of the founding principles of the GIC. I also want to thank the Denver chapter of NABE for its participation and support in putting all of this together. Now, you've just heard a great panel on the global economy, particularly from a financial market standpoint. I'm not sure I'm going to add much to that discussion of financial markets, so I'm going to use my time to talk about something else that I find very interesting and important, and that's the Federal Reserve. In particular, what I really want to do in my time is to discuss several aspects of the many proposals that are out there now and being debated in Congress to reform the Fed. And I want to talk about some of the dangers that I think lurk in that. Now, some of you may know that I have been oftentimes a critic of the Fed, sometimes a very vocal critic of the Fed. Yet I think some of the so-called reforms that are being proposed are deeply misguided. And I'll try to explain why I think that. In essence, my message to Congress is, be careful what you wish for. But that may be asking too much of our Congress. So over the years, you know, we've had calls for reforms of the Fed, and they've come and gone. The Fed's been around for a little over 100 years now. We've seen periods where the Fed is both praised, sometimes vilified, sometimes at the same time from different interest groups and different parties. But in the best of times, central banks should be able to go about their business of stabilizing the nation's currency with little attention from the broader public. Perhaps that's the way it should be. It's the way, actually, most central bankers would like to have it. But in recent years, the Fed's become quite the whipping boy. And indeed, whether it comes from the left of the political spectrum or the right of the political spectrum, calls of reform have grown substantially. So how did we get here? What led us to this point of calls for reform? Central banks have been around for a long time, hundreds of years. The Bank of England dates back to the 1600s. But central banks have evolved. They've evolved as economies have evolved, as governments have changed. And in most countries today, compared to 400 years ago, most countries today operate under what we call a fiat money system. Fiat money system means a nation's currency has value because government says it has value. And the job of the central bank usually is to control money and credit and other things to stabilize that currency, so stabilize a nation's sort of purchasing power of their currency. Now in the United States, the way the Fed does that, the authority it has from Congress, is to intervene or buy and sell in financial markets, selling assets, buying assets of various kinds, in order to control or manage, if you will, the growth rate of money and credit. Now, this ability to buy and sell assets in the open market gives the Fed a tremendous amount of power and authority to intervene in financial markets in one form or another. It's not just about the quantity of assets that they can purchase. It's about the duration of those assets. It's about the types of assets they are. Here I'm thinking about mostly the Fed is authorized to buy government bonds, government treasury bills and bonds of various maturities. But now we bought a lot of mortgage-backed securities. We bought a lot of other assets under the guise of what we call 13(3) lending, when we purchased assets and held them in the process of the Bear Stearns rescue, where we loaned money against collateral. We bought assets against pretty risky collateral, or the outright purchases for we purchased when the Fed essentially purchased AIG. So given this broad swath of power that central banks have, it's absolutely appropriate that governments put some constraints on those authorities to limit the things that central bankers can do. And in different countries under different government regimes, you get kind of different restrictions. But all in all, central bankers should be constrained in some way. But in recent years, what we've seen during the financial crisis and the Great Recession, central banks and governments have pushed the accepted limits of conventional constraints on central banks. The Fed and many other central banks have taken extraordinary steps in their countries to address the Great Recession and the financial crisis. Those steps have challenged the conventional boundaries that central banks. And depending on who you're talking to, these actions have either been applauded or denounced, kind of what perspective you stand for. For example, the Fed adopted unconventional, large-scale asset purchases to increase what was considered monetary policy accommodation after it reduced its primary policy to the federal funds rate to zero, to essentially zero. They bought all these assets. Now, these assets purchases created trillions of dollars of reserves that sit in the banking system and greatly expanded the Fed's balance sheet, as we all know, which is now like $4.5 trillion. But the Fed's done more than just purchase lots of assets. It's altered the composition of its assets, of its balance sheet, to the types of assets it's required. As I said earlier, mortgage-backed securities, more questionable assets like from Bear Stearns and from AIG. Now, the public, and to a lesser degree Congress, saw these events of what the Fed did as exercises in the enormous power that the central bank has. And for many cases, without much of a clue from the public, at least the public didn't have much of a clue as how or why these decisions were made. On the other hand, the Fed and others saw these steps as necessary actions to fulfill their mandate specified by Congress. That mandate is often called the dual mandate, and it's to promote price stability and maximum employment. The Congress also viewed the turmoil in the financial sector as a consequence of Fed failures. Although, as I'll explain later, there were also many other banking regulators involved. There was the OCC, the FDIC, the OTS, and you can go down the list. Probably share that blame. So a number of proposals have been put forward to reform the Fed, and I'm going to discuss two features of those proposals that I think are most fraught with danger. The first is the so-called audit the Fed movement, and the second is the desire to reform the governance structure of the Federal Reserve System, particularly as it pertains to the 12 district banks around the nation. I think these sorts of initiatives are misguided and will not improve the performance or the accountability of the Fed. Instead, they would result in a more political, less independent Federal Reserve System. Some of the reformers actually believe that a more politically accountable Fed with less independence is exactly what's needed. But let me remind you why independence is so important for central banks. The basic rationale for monetary policy independence is that it must have a fair amount of independence from the political fray so that it can set policy for the longer term without the pressure to print money as a substitute for tough fiscal choices faced by the Congress. Good governance requires a healthy degree of separation between those responsible for taxes and spending and those responsible for printing money. The temptation of the fiscal authorities to resort to the printing press for short-term relief from fiscal discipline becomes even more important when it's recognized that monetary policy often works with long lags. Central banks, including the Fed, now have not always been so successful in maintaining that long-run apolitical perspective. But what we do know is that when they don't follow that policy, when they don't follow that long-term perspective, and they become more political, the outcomes are usually even worse than they otherwise would be. So it's instructive, I think, to sort of consider a recent case in point, and that's Argentina. In 2012, the Central Bank of Argentina lost its last shred of legal independence. Prior to that time, prior to 2012, the central bank proclaimed, and I quote, "Its primary function and fundamental mission is to preserve the value of the currency," unquote. Now, if you think about Argentina a little bit, you can surely question whether their effectiveness at this mission had been very good. Argentina is not known for financial stability over the last 40 years. But nonetheless, their less than stellar record has been, their task has been enshrined in their mandate. But in 2012, the country's Congress, the Argentine Congress, passed a bill declaring a new mandate. The new mandate in Argentina is, I quote, "to promote to the extent of its ability and in the framework of policies established by the national government, monetary stability, financial stability, jobs, and economic growth with social fairness," unquote. Central Bank of Argentina became the piggy bank for the government. So what led to this change? Some of you may know the story. In early 2010, the governor of the central bank, Martin Redrado, was forced from office by then President Ms. Cristina Kirchner, who had succeeded her husband as president of Argentina. The governor of the bank, central bank, was dismissed because he refused to turn over reserves of the central bank in order to fund huge government deficits created in part by corruption in Argentina and big deficits in nationalized industries. He refused. He was fired. Later in 2010, the new governor in place transfers to the government from the central bank doubles from about 12 billion pesos in 2009 to 25 billion pesos in 2010. By 2015, the annual size of transfers from the central bank to the government had grown to over 150 billion pesos. It's really not hard to imagine what the consequence of paying for large government deficits with printing more pesos, which is what they had to do. Inflation, which was less than 10% in 2009, by 2015 it had grown to 25%. Now, some of you may know that Mrs. Kirchner was ousted last fall, and the new government is now working to rectify this disaster, and I wish them all the best. I would note that the new finance minister in the new government in Argentina is a gentleman by the name of Alfonso Prat Gay. Alfonso and I had dinner together, along with David, in Paris about, what, 3 years ago? Something like that. He is now their finance minister, but he attended a GIC conference. David and I had dinner with him, and there was a long conversation about Argentina, what happened in 2010, what its prospects were. And I learned a lot from listening to his that conversation. I say that in part because, as a plug for GIC, because that's the kind of people that we end up working with and participating in many conferences. Now you might ask, this tragedy in Argentina, what does that possibly have to do with the United States? We're not Argentina. Nothing like that could certainly ever happen here. Well, I hope you're right, and you probably are. But there are very disturbing signs to me that are troubling. And I'm going to draw your attention to 3 recent events. The first event was in December of 2008, right? In fact, it was December of 2008. Ben Bernanke got a letter from then Senator Chuck Schumer and Chris Dodd. Obviously, there was a lot going on in the fall of 2008, a lot of uncertainty, a lot of things happening. But in that letter, the senators asked Ben Bernanke basically said, look, we're dealing with the automobile companies. They're failing. We don't know what to do. Would the Fed make a loan to the automobile companies to help them out? It would be in the national interest to keep them afloat until Congress could decide what to do. It's a very bizarre request, but perhaps not as bizarre as it might seem. I mean, after all, the Fed, mostly on its own, had already loaned money to rescue Bear Stearns and make it viable as a purchase by J.P. Morgan. We had already loaned money to AIG to rescue them. So perhaps it wasn't as far-fetched for some people in Congress to say, well, if they're doing that in the national interest, surely they should be loaning money to the automobile companies in the national interest. So it wasn't such a bad, it wasn't such a ridiculous idea as you might think. But fortunately, Ben gave the right answer to that, and he says, no, we're not going to do that. That's not part of our mandates. The second event, well, Ben said no, but I think as you'll see, this was an omen of some things to come. And the second event occurred in 2010 with the passage of the Dodd-Frank legislation. In that legislation, Congress required the Fed to provide funding for the Consumer Financial Protection Bureau, the CFPB as it's called. Congress did not want to fight over appropriations for a new consumer protection agency. It was politically hotly debated question. And so rather than appropriate funds for it, they funded it out of the Fed with a fixed percentage of the Fed's expenditures were automatically going to be assigned, some ratio assigned to fund the CFPB. The Fed rolled over without a fight. It acquiesced. Now, of course, what's important to remember about this is that this does not mean that the CFPB isn't being funded at taxpayer expense. Because all it means is the Fed will turn over less money to the Treasury at the end of each year because some of that money has been used to fund the CFPB. So the taxpayer, it ends up footing the bill at the end of the day, no matter what. But Congress was more interested in creating a smoke screen to avoid having to pass annual appropriations for the controversial new agency. So now the expenses of the Bureau are not part of the appropriations process, but are automatically paid by the Fed. More than that, which is interesting, is that the legislation in Dodd-Frank that made this explicitly specified that these funds that went to the CFPB were not reviewable by Congress. Not reviewable by the appropriations process. This is about, as I said, smoke and mirrors. This is about abdicating the Congress's responsibility for appropriations and saying it's automatically funded by the central bank. Now, the third event I want to talk about is probably the most serious and the most recent. Last fall, Congress chose to fund a portion of the highway transportation bill by using the capital surplus account of the Fed and reducing dividend payments to those large banks that have chosen to be member banks of the Federal Reserve System. This is another attack, if you will, on the Fed. This is poor policy for a number of reasons. First of all, transportation infrastructure projects, transportation bill as it's popularly known, has typically been, and correctly, been funded by user fees, gas taxes, other sorts of user fees for the roads, and that was how you matched user fees to spending on that activity. And that was correct. That's been abandoned. Worse is this action is further evidence that Congress increasingly seems to think of the Fed, of our central bank, as a source of funding for fiscal initiatives. Independence is incrementally being thrown out the window. And I'm afraid the Fed has not put up much of a fight. I think that's bad. Are we Argentina? No, hardly. But I am troubled by the cavalier attitude of Congress towards this independence, and it's not encouraging. Just imagine in another administration, the next administration, when the calls for infrastructure spending grow to trillions of dollars for roads and infrastructure, and whatever you want to classify as infrastructure. There will be calls for the Fed, the central bank, to, quote, share the burden. And it will be a direct attack to avoid the fiscal discipline of Congress deciding what to spend and how to pay for it. Shift the burden of tough fiscal decisions to printing money in the stead. And that's troublesome. So when I look at the reforms being proposed in Congress, I generally assess their merits through their potential impact on monetary policy independence. And the processes, the political process that become, through which that will take place. So let me return where I started a bit. The elements that are common to a number of the reforms being discussed, for example, to audit the Fed and governance changes, politically make the Fed, from my standpoint, less independent and more political. The Audit the Fed movement was initiated by former Congressman Ron Paul, of course, and is in part through misrepresentation of what that really is, and public ire over the financial crisis. It still shows up in reform legislations over and over again. It's become kind of a litmus test for reform. The first thing to understand about Audit the Fed is that these proposals are not about financial audits. Financial audits of the Fed are done by the government, by the Fed, and by private sector accounting firms. So there's plenty of both internal and external audits on the Fed's financials and their balance sheets. In fact, how many of you publish a balance sheet every week? The Fed does. I mean, it's no big secret. What's really being contemplated here is not financial issues. It's an audit of monetary policy. It's a policy audit. The Fed's independence is currently confined to monetary policy. And the Audit the Fed reforms are really explicitly to remove monetary policy from the exemption of policy audits by Congress. That is the crux of the issue in Audit the Fed, removing monetary policy from its independence. Now, it's important to remember that verbatim transcripts of every Fed meeting and documents associated with every FOMC meeting are currently available to the public with a 5-year lag. Is that the right number? I don't know. Maybe it only ought to be 3. But everything is disclosed at some point in time after the meeting. Now, the different bills for Audit the Fed have some details, but the thrust of them would be to allow any member of Congress at any time to call for a GAO audit to investigate a policy decision. In principle, this could happen immediately following a meeting or any time thereafter. The GAO then would come in, assess all the documents, transcripts, meeting information, and conduct an audit of that decision. From my perspective, as someone who's sat in that room for FOMC meetings for 9 years, this opens the door to considerable political pressure and influence. Just imagine, what would be learned from such an exercise to begin with? you certainly wouldn't learn whether the decision was a good one or not. Monetary policy effects usually don't arise for many quarters, sometimes several years. So evaluating whether it was the right decision or the wrong decision is not something you're going to discover. And every time a decision is made anyway, financial markets and financial writers talk about it all the time and debate whether it was a good decision or right decision or what it meant. So what else are you going to learn from this audit exercise? You can also imagine how politics will become a focus in the FOMC meetings. Will members restrain their comments for fear of being called before Congress or the GAO the next week? Committee members would certainly be more circumspect in what they had to say. Will the policy decision be affected by whether it's likely to inspire someone in Congress to complain and call for an audit the day after the announcement? Will just the threat of such actions have a dampening effect on the discussion, making good policy decisions even that much more difficult? Imagine what would happen in an election year like we're in now. Imagine the political pressures to every time the Fed meets, 8 times a year, somebody wants to call for an audit to the Fed, to make a political point, expose it and use it for political one-upsmanship and spin. What a terrible way to run the conduct of monetary policy. Thus, my views of the real effects of audit the Fed proposals would be to further undermine and sink the FOMC ever deeper into political calculations rather than improve the decision-making, transparency, or accountability of the Federal Reserve. So let me turn to another topic that frequently appears on the list of reforms, and that's governance. Many reforms entail some changes in the governance structure of the Federal Reserve Banks. The Federal Reserve System is comprised of 12 reserve banks and a 7-member board of governors in Washington. Each independent reserve bank provides a vehicle to gather and assess economic information and data from around the country. They also conduct independent research from various analytical perspectives. So these activities that all occur in the different reserve banks play an important role in providing both diversity and depth of understanding about both the economy and monetary policy. They provide timely information about the state of the economy. And it helps ensure that monetary policy doesn't slip into groupthink, as many agencies in Washington often do. That diversity of thought brought by the reserve banks, whether it be in Kansas City or in Philadelphia or wherever, make for a more independent Fed and for better decision making. One of the ways in which that diversity is provided is that the reserve banks themselves and their boards of directors appoint the president. Each board is made up of 9 individuals, in case you haven't heard, representing the public. 6 of those 9 directors are from nonprofit or community organizations as well as private businesses. And 3 out of the 9 directors are bankers from district banks in the district. However, final approval for a president is made by the Board of Governors in Washington. For example, my former board of directors at Philadelphia, only the 6 non-bankers get to make the decision about who they want as president. And at the end of the day, that request must be submitted to Washington, to the Board of Governors. And of course, they're all political appointees as opposed to independently elected, and approved by them. Thus, the presidents are not beholden to one particular political party or interest group for their appointment. Yet, despite the benefits, as I see it, this structure, some see this system, particularly with the role of bankers on the reserve bank boards, as flawed and deeply in need of change. Some would make bank presidents political appointees, just like the Board of Governors. That seems to me to be doomed to political infighting. The Board of Governors in Washington is made up of 7 members. You may or may not realize that the Board of Governors hasn't had 7 members, a full complement of governors, in more than 1 or 2 years out of the last 15. Why? They don't get through Congress. Either the president fails to nominate someone, or it gets bogged down in the political process of hearings for presidential appointments. Imagine how many, if the political process was going to appoint 12 presidents in addition to that, it would be hopelessly politicized and it would lead to paralysis in some form or other. So I don't think this is a very good idea. Another role is to remove the role of presidents, take them off the FOMC in monetary policy making. This will also lead to greater political interference in monetary policy decision making. And more political decision making should not be the goal. And if you want to avoid groupthink, I would note that if you remember, the FOMC is made up of 7 members from the Board of Governors and 12 Reserve Bank presidents. Not all of them vote every time. If you look at the frequency of dissents, that is, who is making dissents in policy actions? Governors have dissented. Now remember, there are 8 meetings every year, 8 votes every year. Since 1996, there have been only 2 governors to dissent in 20 years, or 15 years. Oh, that's 20 years. In 15, only 2 dissents by governors. That doesn't sound like diversity of opinion to me. It is not. It's groupthink. So politicizing the Reserve Bank presidents or removing them from any role in monetary policy, I think would undermine an important mechanism for ensuring independent central bank and a diversity of views in monetary policy. I mean, at least there's some reformers who will admit that's exactly what they want, but I would say be careful what you wish for. Welcome to Argentina. It's also important to ask, well, what problem will changing the governance structure solve? So what problem this is the solution to what? If you look back over the post-war era, post-World War II era, and ask yourself what were the biggest mistakes of monetary policy, biggest mistakes of the Fed, I don't see, and there have been big mistakes, don't get me wrong. It had nothing to do with the governance structure. So I'm going to consider 2 of the so-called big mistakes of the Fed. The first, most obvious, is actually the great inflation of the 70s. It's hard to say anything of that was a huge policy error by the Fed. Now, but why did that policy error occur? Did it occur because the Fed wasn't politically accountable enough? No. The story, whether it's entirely apocryphal or even literally true, is that LBJ, President Johnson, took the chairman of the Federal Reserve Board, William McChesney Martin, at his ranch in Texas, took him by the lapels and told him, "You will support my Great Society programs and the Vietnam War with easy monetary policy, low interest rates." Martin obliged. That's exactly what he did. And so did Arthur Burns after him. Now, whether the political pressure was quite so blatant or not, it was clearly there. But the effect was the same. The source of the great inflation of the 70s was not enough political accountability. The source of the problem was too much political influence. A different governance model where all the Fed presidents were political appointees would not have solved this problem. It would actually have probably made it worse. The other major crisis, of course, is the recent crisis, the financial crisis and the Great Recession. Some have argued that this was a monetary policy failure as well. The Fed kept interest rates too low for too long between 2003 and 2006, and that contributed to the crisis. Others say the Fed was responsible, but maybe had more to do with their regulatory failure rather than a failure of monetary policy. So let me talk about the regulatory failure first. Some have claimed that because the Federal Reserve Bank presidents have bankers on their boards, that they are captured. And they're captured by the banking industry, the argument goes. And so the governance structure with bankers on Federal Reserve Bank boards is a source of conflict of interest and works against good regulatory policy. I've been a bank president, had bankers on my board. I would say I think this is a flawed argument. First and foremost, regulatory responsibility does not rest with the reserve banks. Regulatory responsibility rests with the Board of Governors in Washington. The reserve banks only do supervision in regulatory matters as a delegated responsibility to the Board of Governors. I, as a bank president, never had any say-so in regulatory matters or supervisory matters. Again, responsibility rested in Washington. So making the bank presidents or taking bankers off the boards, they had no say-so in regulatory matters anyway. So it kind of seems to me it's beside the point. It's the political process of political appointees in Washington that have the underlying authority, not the banks. Now, I'm not meaning to absolve either the Board of Governors or the presidents or the Fed for responsibility in regulatory mishaps. They certainly made some mistakes. Capture, as it's usually referred to by economists, is a real concern for all regulatory entities and must be guarded against. But what I will argue is that there's no compelling evidence that says the structure of the Fed was an important root of the problem, or that changing the governance structure would have had a different outcome on the process. There are other regulatory bodies. The OCC regulates national banks, JP Morgan and Citi. The OTS was responsible for the thrift industry. AIG was overseen by the OTS. WAMU, Countrywide, were all regulated and supervised by not the Fed, but by the OTS. The FDIC, responsible for state-chartered non-member banks. And the SEC was responsible for investment banks, including Bear Stearns and Lehman Brothers. OFEO, now defunct agency like the OTS, had responsibility for the GSEs, Fannie and Freddie. None of these agencies have the governance structure that the Fed does. They all were direct political line of sight appointees by Congress and by presidents. So they didn't have this governance problem. But they made the mistakes as well. They made the mistakes as well. So changing the governance structure wouldn't have seemed to have made any difference. I mean, even looking across countries. The UK had a financial stability authority, not a governance structure like the Fed. In fact, it was Bill Poole, former president at the St. Louis Fed, who preached from 1998 to 2008, till he retired, about the problems at Fannie and Freddie, that they were undercapitalized and they were at risk, they were fragile. It was going to be a disaster. He was right. Fed didn't have any ability to control that. We talked a lot about it, but it was Congress that didn't want to do anything about Fannie and Freddie, not the regulators. So I might note, so I don't see the governance structure as really a source of any problem. Every agency fell short in some respects, and so changing governance structure I don't think is going to yield any better outcomes. On the monetary policy failure, keeping rates too low for too long, I think that has some merit. I kind of agree with that. Whether that's the whole story or not, it's less clear. But what would have led to different outcomes? Would changing the governance structure make those decisions different? As I pointed out earlier, during that period, it was the presidents that were dissenting against low interest rates, not governors. So the presidents were the only voice of dissent. And indeed, some people could argue that, in fact, what you really need for better monetary policy is to rebalance the authority that's vested in the presidents versus the Board of Governors. And indeed, to be fair, there are some proposals that do that. I think those would be good. So I would argue that the biggest failures by the Fed, and there have been some, the biggest failures, though, have not come from lack of political accountability or political control. It's actually too much political interference in independent monetary policy. So So overall, when I look at proposals to reform the Fed, there's some good ideas out there. I haven't really gone into those, but these are the ones that worry me the most, because any proposal that at the end of the day makes the Fed more political, less independent, I think is fraught with challenges. To me, some of these proposals are the wolf in sheep's clothing. Looks nice superficially, but underneath it's dangerous and will undermine, I think, effective actions by the central bank. I'll stop there. Thank you. So I've got time for a couple of quick questions, so I'll be happy to talk about what I talked about or anything else you'd like to talk about. By the way, I'm not like Bill Clark anymore. You notice I didn't have to say I speak for myself and not for the Federal Reserve System. I don't speak for the Federal Reserve System. I don't even have to say that, which is really nice.
Mike England.
I have one question, another avenue for the issues of Fed independence. With quantitative easing, with quantitative easing, the Fed now has this large portfolio. Arguably, if rates rise fast enough, the value of that portfolio could fall enough, the Fed would need to be recapitalized. One could see that as a constraint for Fed hawks who may not like the political process of having to go to Congress, restructure the Fed. One could also look at that as a control mechanism by governors over the Fed presidents, given the governor's bias toward an easier policy stance. As you know, the presidents tend to dissent. It's a dissent toward tightening. Do you have thoughts on that particular avenue of Fed independence?
So I think the Fed's balance sheet is very big. You're right. If interest rates go up because we now pay interest on reserves, you can get into the Fed's balance sheet. You get into a lot of complications with the U.S. government, with the Treasury. But if you consolidate the balance sheet of the Treasury with the balance sheet of the Fed, all this is sort of, not particularly relevant for macroeconomic policy concerns. But it would be, for example, I was not a big fan of the quantitative easing and blowing up our balance sheets for lots of different reasons. One was what I would call a political economy question, not a financial or purely economic question, but political economy. So the concern would be that and you're seeing this come to pass right now. Janet Yellen's being called before Congress and questioned about interest rate on reserves because they know that if interest rates go up, then part of the income the Fed has, which is the interest earnings on its big balance sheet, part of that money is going to go to banks who hold excess reserves, and the amount of money that's turned over to turned over to Treasury will be less. They now understand that. And as a result, ask yourself, well, what if a reform were to come to pass where the Congress decided that because of that issue, they're going to take away the power to pay interest on reserves? Now the Fed's sitting there with a $4.5 trillion balance sheet, interest rates at zero, and no way to control it without massive asset sales of some kind. It would be it would be an unmitigated disaster. Now, but I want to go back. It's not an issue for macroeconomic policy, because if you look at the consolidated balance sheet of the Treasury and this, it's all smoke and mirrors. If the Fed pays interest on reserves, then effectively that's no different than a bond, the Treasury issuing government debt. It's just a question of which the interest rate payments flow through. Does that flow through the central bank, or does it flow directly to the Treasury? In either case, it doesn't make much difference. In terms of capitalizing the Fed does not mark to market its balance sheet, and there's reasons for that. There are reasons for that. So exactly, you don't get the Fed making monetary policy decisions based on its capitalization. This is not a traditional bank, central bank. It's a central bank, and it can recapitalize relatively easily. And we already have a mechanism for deferring payments to Congress, if that's to Treasury, if that's what it needs. So I guess most of the stuff about capitalization in the central bank, that's just kind of noise to me. I don't think it's really fundamental to conducting monetary policy or to the economy. It could be if it manifests itself in other things, like I said, about like doing away with interest on reserves. That would be bad. But I don't think that is the real issue. And it's not really an issue for the FOMC. We understand perhaps the political economy implications of this, but it doesn't have any fundamental economic consequences, if you get what I'm trying to say.
One more.
Hi, first of all, thanks for coming, and Colorado. My question is, how sensitive do you think Fed monetary policy would be to the development of TTIP and TPP, given instability with Brexit, as Kozo touched on, candidates, potential presidential candidates' policies towards those trade agreements?
So I think the Fed will stay very clear of those discussions. But I would say the following. My view of Brexit was it's going to have relatively little effect on the U.S. I actually think it's going to have more effect on Europe than it is on the UK, despite what some people are saying. I think the UK will turn out just fine. It'll take a while. There'll be transition costs, and there'll be costly things that have to take place. So I'm all for free trade. More trade we can have, more channels of trade we keep open, the better off we all would be, I think. I think Europe will make a huge mistake if it tries to punish the UK for leaving. I think from the UK's perspective, they've had enough punishment, which is why they voted to leave. And it wasn't over trade, it was all the other stuff that the EU was trying to impose on market structure, migration, welfare. I mean, just go down the list of things that the Brits complained about. I had some say so. I think that what the U.S. ought to do is immediately turn around and offer to let UK join NAFTA. That would be at least as large a group of trading partners as the rest of Europe might be. Why don't we do that? Make Britain better off, and it would certainly make us better off to expand that. I think it's unfortunate that, like the TPP and other things, is getting such bad press. Like I say, I am for free trade as much as we can get there. And I think it does worry me that the kind of populist backlashes we're getting about trade is, I don't think, very healthy. Some of you can probably remember this back when, Patrick Buchanan was running for president, and I can't remember what year that was. Anyway, these populist episodes have come and gone at various times, and they always leave some scars. So I think a lot of the fear that people had over Brexit, the U.S. stock market is now back above where it was before the vote. The UK stock market is back above where it was before the vote. And so I think that the effects are going to be muted. The most effects will be felt, obviously, in the channels between UK and Europe, but I think for the rest of the globe, it's going to be pretty minor. And Kozo was sort of suggesting the same thing, I think. And I think the FOMC will want to stay out of that discussion.
Charles Plosser. Let's bring up the final panel. We promise everybody we'll have a hard stop in time for people to get to lunch, so we'll have the last panel now.
So we're supposed to have a break?
Are we doing a break?
Well, it's on the schedule. Do you want to give them a few minutes to stand up?
The break is 5 minutes while we adjust the panel, and then we'll commence.
Thank you.
You're just waiting for the break.
Okay. I wasn't sure.
Thank you.
done with this computer? That's what it sounds like. I'll just get this out of the way for now. Sorry. I didn't know what kind of reaching for this. Oh, really? I need this mouse here. Your own. Well, I see it.
And then
Do you need this slide advancer or this mouse or anything?
Sure, slide advancer. We just can I plug it in?
Yep.
That should be universal, right?
Yeah.
I don't need special software. Just goes in.
It should. It'll. If you're online, it should grab the driver it needs for it.
Yeah, they're on Roberto's computer already.
Might take a minute or two for it.
And he's, while working on the whole, he's been showing a number of charts and stuff that'll help support everything. I've got a bunch of slides where I can get through.
Hey, John. Hi, Roberto.
Roberto, John.
I have your slides on this computer.
Yes.
Great. And I'm going to have a couple of things. Yeah, slides last night, this morning, I found that this could be yeah, then as soon as I'll be your assistant. I think so. Yeah, I think use you on. The macro picture. Okay, so it's gonna be here.
Yeah, I'm gonna get her my card.
Yeah, it sure is. That's great company.
Okay, if I can have everybody's attention, we're gonna get the second session going.
I don't have any. What's that? I have nothing. Oh, yeah. Oh, zero exposure to versions. Most of my app guys here.
Yeah. So as we make our trek from broad macro, global outlook, central banking, we're going to try and take it down to a more granular level with the second session, which is the industry panel. Our moderator is going to be Roberto Casilla. He is a finance teacher at Leeds Business School, and he's the faculty director of the Burridge Finance Center in Boulder. His name's going here. Representing the oil and gas industry is going to be John Harpole with Mercator. Mercator Energy. So John's firm trades and brokers energy, representing producers and users. They trade about 1 billion cubic feet of natural gas a day. He'll be speaking on oil and gas, has a broad background in fracking, how that works. He's had several trips to China, advising PetroChina. Then we have Jay Rollins with JCR Capital, representing the commercial real estate industry. His background is in originating commercial loans. And then we have Marty Schmitz, chairman of Citywide Banks. He'll be giving a perspective both from the banking sector, credit availability, and small business. And with that, I'm going to hand it to Roberto.
Good morning, everybody. As you can probably tell from my accent, I'm not from Colorado, but I moved here as soon as I can, like Mr. Professor, and we're all happy to notice that you already started wearing the Broncos colors on your tie, so thanks for that. I spent 14 years on Wall Street, and then I fell in love with the Flare Irons, and I moved here, and now I'm at the University of Colorado, the other campus, the one in Boulder. So I endured Route 36 this morning to come here, but it was a pleasure to be here. We thank the panel before us and Mr. Plosser for setting the stage. What are we? We are in a very interesting intersection of the financial markets and the macroeconomic forces and politics and events. I was listening to the speakers, and I was browsing a little bit the Bloomberg here to put a couple of charts as teasers to kind of provoke questions. We have 3 panelists here who are passionate about energy, about the real estate world, about the place, the regulations and the current politics are taking the United States. Just want to share a couple of things with you, just to provoke a couple of questions. So where are we now? You are right here. So this is the world dead clock. Count the zeros. I couldn't. Let's zoom into the United States. This is us. Debt per citizen is about 60 grand. So as soon as you're born, you wake up with 60 grand of debt. Welcome to the world. The interest per second is about $15,000. So as I'm speaking, thousands of dollars of interest are going by. And this is the interest that we're accruing per year. This is, computer is saving energy. This is the speed at which we got to that point. You can probably recognize the growth after 2008. There is another picture that always interests me, and I show it to my students, which is this one here. And this one, I haven't quite figured out whether we are in a bad spot or not quite yet. What do I mean by that? So this is an interesting picture. On the right-hand side, you have the S&P 500, and you can probably recognize if I put my mouse on it here, you can probably recognize the dot-com bubble. Here, this is fall 2008, and this is where we're now. So it looks like a camel, and we are at the head of the camel, but if I look on the left-hand side, that's the shape of the yield curve. So let's take a look and play the time machine for a moment. If I go back here, when we were at this bubble, interest rates were high, and the interest rate term structure was flat and high. And just before the bubble, then everything took a nosedive. As soon as the market went down, the interest rates went down, and the Fed clearly did their job in lowering interest rates. The market was saying, yes, interest rates will go back up. Fast forward, we have another problem. We have another bubble. Now we're here. Interest rates are high again. The S&P is about to arrive at the 2007 bubble, and interest rates are high, and the world and the markets are projecting interest rates to be high and stay high. And then the storm arrives, and interest rates go down to zero. The financial markets are saying, yes, this is what the Fed is doing in the short term, but interest rates are going to stay high. I'm going to come back to high. We kept saying that for about 8 years. And the market recovered, and interest rates stayed low in the front and steep in the back. And where are we now? If we were in a bubble now, we would be a lot higher and flat, but we're not. Is the history not repeating itself? Is this just a little inflection point? What are the macroeconomic factors? Let's take a look. This is crude. This is crude oil that is close to John's heart. Crude oil, energy, natural gas is very close to his heart. They move about 1 BCF a day, one of the 80, if I remember correctly, that the United States is moving around. And but energy has been not too expensive now. If we look back at 2008, before the collapse, we were about there. We exceeded $140 per barrel, and today we're not. Is there too much energy there? So these are little provoking charts to trigger thoughts and questions. But given in the spirit of keeping time management under control, I'm going to switch this to the slides that John has prepared for us, so he can go back and forth. I think that you can click on this, or you can just do page up and down. And I'm going to step to the side.
Great, thank you, Marco. What Marco didn't admit is that the city that he left, that he was raised in, that he claims he loves Boulder now, is a city that I love so much, and that's Rome, Italy. So to move from Rome to Boulder is quite a move. But I'll switch places with you someday, I hope. So I've got to confess, I kind of feel like blue-collar plumber in a room full of genius architects. And so I plan to spend a little time with you. The observations that I've made over the last few years in terms of what's going on in the industry, and I think from my perspective, being in the industry for 33 years, we've seen a fundamental change in this concept of scarcity, and that's been brought on by what we call the U.S. shale revolution. And I think that will change the energy discussion for some time, and really my talk will go through about 20 slides in 10 minutes here, 10, 15 minutes. My talk really revolves around how that will impact the world. Again, thanks to hydraulic fracturing, horizontal drilling, and I got to emphasize the private property ownership of minerals in the U.S., which is unique to the U.S. We've come up with a shale revolution that I believe has changed the world in terms of the discussion of energy scarcity. I would argue that energy that was once scarce is now super abundant. And what we will address over the next 30, 40, 50 years is moving that energy where it's most needed, And fortunately, that'll deal more with free markets than anything else. So what happened? U.S. oil supply rose, and I'll show you some slides on that are stunning, to say the least. We had an unexpected large supply growth out of Iraq. The decline in U.S. drilling recently cannot unilaterally impact the world price for oil. In the last year, the top 6 non-U.S. producing oil countries in the world, these are primarily national oil companies, in the last year, those countries have increased their production by about 2 million barrels per day. Even with a 75% decline in crude oil drilling here in the U.S., we've only seen the volume drop by 500,000 barrels per day. And so what I would say to you is that we cannot unilaterally impact the price of crude oil worldwide. Now, do we have a higher degree of energy security than ever before? I'd say absolutely yes. But we cannot force, just by our own actions, force the price up or down or sideways. What we can do is put a cap on that price relative to the expenses that we share, enjoy, or understand, or experience here in the U.S. So it's about the global economy, and I believe China is the key. I was the gentleman that asked Como the question about the one-child-only policy, because I think that policy started out of concern for abundant resources or scarcity of resources. And I've got to think that that was an element in the discussion that the People's Party to decide to allow, above and beyond the demographics, allow folks in China to have more than one child. This is the active rig count in the U.S. It's down 75%. That's vertical, directional, and horizontal. But across the board, we've seen a significant decline in the rig count. We've seen it region by region. Now, these are the regions that if you really want to understand our business, those are the regions you want to follow. Look up in the top northeast quarter of the U.S., the Marcellus Utica play. When I was the natural gas buyer for General Electric from 1987 to 1992, the only place I could buy natural gas from my 60 GE industrial plants on the east half of the U.S. was down on the Gulf Coast. And yet now we have this production volume out of Marcellus and Utica that's astounding. Consider in 2008, Western U.S. producers, primarily producers in western Colorado and southwest Wyoming, built a $4 billion pipeline to take natural gas from southwest Wyoming to eastern Ohio. And in the analysis for the Federal Energy Regulatory Commission, we anticipated that we would see over the next 10 years a demand increase of 2 billion cubic feet of gas per day. Now, as Marco said, we consume about 80 to 85 billion cubic feet of gas per day in the U.S. My small little company out of Littleton manages about 1 BCF. So we saw the economic advantage of moving gas from western Colorado, southwest Wyoming to Ohio. And we were willing as producers and shippers on that pipeline to pay $1.25 a unit to move gas to Ohio, because we thought over the 10-year commitment that we made that we would see a price increase because demand would increase in the Northeast by about 2 billion cubic feet of gas per day, which is ostensibly is the volume of gas that we were moving. Well, with the discovery of natural gas in the Utica and the Marcellus, we've come up with now, today, 16 billion cubic feet of gas. We anticipate that number in a couple of years could be 20 BCF of gas per day. So you want to talk about well-planned economics around a $4 billion pipeline that have been turned on their head. In a sense, the capacity on that pipeline that we're paying $1.25 a unit to move is now worth about 10 to 15 cents a unit. So again, if you want to understand our industry, these are the different areas to really focus in on. I was just really talking about the Utica and Marcellus. But here's the story. So I was in China 3 years ago. I was sitting next to the country manager for EOG. I asked Andy, I said, how many wells have you fracked, horizontal wells have you drilled and fracked? He said, John, this is as of 3 years ago, we've only drilled 26 horizontal shale wells in all of China. Horizontal shale wells in all of China. I said, Andy, how many could you frack on any given day? He said, John, the last time we fracked a well, every frack truck in Asia was on location at our one facility. In the U.S. and North America, 2.5 years ago, we could frack as many as 300 to 350 wells on any given day. And that's shown by the growth in frack horsepower over time. Look at the pressure pumping services that have increased over time also. Now that equipment is still available, but I'm starting to get concerned about the people that are running that equipment because of the serious decline in drilling. But this is our America Shale Revolution. You get an idea of the growth in crude oil production in the U.S. from 2007 or 8 to 2015. This is our growth as compared to Saudi Arabia. You know, someone nicknamed it Saudi America. These are the three areas in the U.S. that 10 years ago you'd never dream that they'd be producing more than 1 million barrels of oil per day. And of those three, the one that's really still in the money in terms of economics, internal rate of return for the companies, is the Permian Basin. This is why the House of Saud reacted, we think, in the way that they did. In essence, 55% of the new liquid production in the world was coming out of the U.S. And that's why Saudi Arabia decided they would not cut their production quota some 2.5 years ago. That was the reaction, because of the growth and success of the shale revolution here in the U.S. This is one of the comments from 2014, just less than a month after the Saudis maintained their production quota. And this is from a Russian oligarch who, in essence, said the shale boom is on par with the dot-com boom. The strong will remain, the weak ones will vanish. He referred to the U.S. production market as the American marginal market. Now again, we've seen a cut in drilling, but there hasn't been a commensurate drop in production quite yet. This is the price that each one of the countries on the left-hand side have to receive for crude oil, the price they have to receive to balance their budget against their social welfare programs. Okay, that game that Saudi Arabia started 2.5 years ago is approximately, I think they started with $750 billion in foreign currency reserves. But some folks have called this a game of chicken, and 9 of those OPEC member states cannot balance their budgets. To jump to a different discussion though, China in essence invested $430 billion from 2005 to 2013 with energy as the focus. So again, a small group of people deciding which direction things might go. They were concerned about the commodity price of oil and natural gas and made investments worldwide to the tune of well in excess of $400 billion, all under the assumption that oil prices would continue to be scarce. And I would argue that is and was the wrong bet. And those countries will suffer for it. China, without significant demand in China, I really don't see a growth in demand for oil unless we see it out of China. And as a result, I don't see an increase in the price for crude oil. I think we're range bound in a price of anywhere from $45 a barrel where we are right now to $55 a barrel for the next 5 years. And it would be very easy for me to stick my neck out and say 10 years, barring any kind of black swan event. And so we're just kind of mesmerized in the lack of growth worldwide. This one really struck me, and it struck me in large part because we had a number of different encounters in China that really stirred this issue for me as a father of 3 kids. But imagine 4 grandparents, 2 parents, and 1 grandchild. And imagine the arguments that had to go on for years between the demographers in China at the People's Party's Central Committee's meetings and discussions about the workforce, labor force, and the possible discussion that maybe energy and some of these raw materials are not as scarce as we once assumed 20 years ago. I'd like to think that that was part of the discussion, I don't know. But there's certainly a demography issue related to that I think embedded within that will certainly be some kind of discussion about demand. I put up this quote in the first presentation to 200 students all members of the Central Party Pricing Committee, 2 different subcommittees, and employees of Petrochem. I put up this quote, and in the 2 different 3-day-long seminars that I gave over 5 years, I got the biggest murmur from the audience on this, to the point where I really thought the first time I needed to duck and cover. But it's a beautiful comment in the sense that the free market knows much better than any small handful of folks making decisions for us. So here's a real eye-opener. This is the price of liquefied natural gas delivered to different ports. Look at China and Japan. This is back in October of 2014, right when Saudi Arabia decided they would not cut their production quota for oil. Now again, this is liquefied natural gas delivered to those ports. That was the price then. Look at it now. $10 decline. We see great length in liquefied natural gas supplies. If you look on a 30-year profile of any liquefied natural gas import or export terminal, the capacity utilization of that terminal has never really exceeded 20 to 25%. And so again, we wait on the world economy to tick up. Now, what has that price crash done to the U.S.? These are the different sectors that have lost jobs. In the conclusion, really, rather than I've spoken about a lot of this already, I fully expect that the natural gas price in the U.S. will be the driving factor in determining where investments go, and not the oil price. We've seen over the last 3 to 4 years that 20% of the total natural gas that's available for our consumption in North America comes out of liquid-rich or oil plays, okay? And so when we see the decline in drilling in those oil plays, the contribution of what we call associated natural gas is just not there. And yet that is so tied to the world price for oil that I think we're going to see a decline in natural gas that does not meet the kind of demand profile that we expect, or that we're anticipating. And so we could see a natural gas price in the $4 range within 12 months. And you see little glimpses of that. We're at $2.85 right now for MMBTU. If we'd had a winter last winter, I think we'd be 30 to 40 cents higher. So you may actually see the underlying reason for drilling in the U.S. shift from oil and liquid-rich gas plays to just pure dry natural gas plays, something that we'll see. I'll close with this slide. This is a friend of mine, Porter Bennett, put this together. We call it the Ferrari effect. And in essence, it measures the reserves brought on by one rig. So at the bottom case there is one rig, and the reserves that well brought on moved out to a second rig, a third rig, or fourth drill site, fifth drill site. Those are the reserves that one rig can generate. Now, if you decide that you really don't like the gas price and you decide to stop drilling for 6 months, and then you restart drilling 6 months later, look how quickly you get back to the reserve production ratio. It happens within 5 months. That is our ability to respond to a price signal. And that's why I think we'll always be keeping a lid on the worldwide oil price, because as that price signal comes to the producer, we can respond. And I think, again, affect the price as it runs away from us, but certainly affect the price and enjoy some semblance of energy security, not energy independence, but energy security. I'll turn the mic over now to our next speaker. Thank you.
Thank you very much.
We'll try to keep the format as the previous panel. So write down your questions and hold on to the questions, because then after everybody had a chance to share what's close to their hearts, we'll go through Q&As. So clearly, if we are now switching over to Jay, we want to consider a few things. And Jay's heart is close to the real estate markets. And clearly there are some macroeconomic factors, and energy is one of those. The other one is interest rates. Before we jump into that, given that I have a microphone, I would like to ask the audience, how many people in this room think that interest rates will be touched on the way up in 2016? How about 2017? Okay. How about 2018? Okay. So clearly nobody thinks that interest rates will go up in 2016, unless you were shy and you didn't raise your hand. And clearly that is could be a very interesting opportunity for the real estate market to start buying homes. Interest rates are low. In a way, I heard the same comment about the energy market. I heard a comment by somebody that quantitative easing a few years ago and the cheap access to capital has offered the opportunity to many people to borrow money and build oil storage, and it turned the United States into the oil sponge of the world. Is this happening also in the real estate world? I would like to ask Jay to share with this audience his thoughts about interest rates, the opportunity for the real estate market, and make a prediction on the market so we can all put our 401k on it. But before we do that, I would like to share this chart here. This is an ETF. This is an iShares real estate ETF, and I would like just to put on the screen the historical chart, just to be your kind of background screensaver. I need to probably get out of this. And this is the chart of the real estate index. Let's go back 5 years. Let's go back more. Jay, would you prefer to speak from the table or up here?
I'll speak up there. Fine.
It's quite a thrill.
It's a thrill. Yeah. No. You must lead
Jay
quite a
Rollins.
life. That's a thrill.
Thank you.
All right. These are not totally prepared remarks, but since I saw what we were doing here, I'm going to talk to you about the real estate market, our view, investing, making money, and how this macroeconomic picture dives into what we do every day for real estate. Just a quick note on us, because I think it sets the tone. JCR Capital is an alternative investment manager that uses real estate as its investment tool to create alpha for our investors. And our investors are high net worth individuals, family offices, pension funds, insurance companies, foundations, and we run a fund model to make these types of investments, and these are all in commercial real estate for the most part. And it is it's a value add, distress, special situation, shorter term hold. We prefer to be a shorter term hold, and this is going to be part of my comments, for all the reasons you're here. Because everybody is struggling all the time with where are we, right? And if you're struggling with where are we all the time, we prefer to be in and out, have a 2 to 3, sometimes 4-year time horizon, create value, take capital back, distribute that to our investors, and then reinvest with clarity on what's happening in front of you then. Said another way, unless you're a family office or you're a long-term holder, I mean, if you want to buy and hold for 10 years, you're probably going to come out all right. We're not talking about that. I mean, we're talking about creating 18 to 25% returns and 1.5 to 1.7 multiples over a 3 or 4 year period, and really making money. Anybody can go buy REIT stocks and take your 7 or 8 and pay ordinary income taxes on that and go home. We're not interested in that. We're talking about really making money in real estate. So that's a short-term view of how do you take advantage of getting in and getting out and then creating returns. Now, once we have that kind of set, and you want to talk about, and I'm going to tell you right from the onset, the interest rates are not the driving factor for what we do. We pay a lot of attention to them, but they're not what's really creating the opportunity set for us right now. And we're going to separate the world here in a second. So you have your trophy assets in New York, San Francisco, Washington. Those are going to be driven down. I mean, those cap rates will be driven down. Those values will go up. Those are going to be seen as a proxy for bonds. And you'll see foreign capital continue to rush into that. And you will see those values continue to go up as interest rates stay lower for longer. I think we're all in the camp of lower for longer. So the GM building in New York probably has more room to grow in terms of value. But I don't think anybody in this room is an individual investor in the GM building. So let's talk about something else. Let's talk about middle market commercial real estate, because that's what we do. And that's really where the alpha is. There's no alpha in buying the GM building. And we describe middle market as assets that are $50 million or less of total value. So if you run those numbers, what we're seeing here in the middle market, and if you look at the total real estate market in the United States is $20 trillion. Assets of $50 million or less are $10 trillion, so half of the market in dollars. There is no statistic on the number of buildings. So let's just say it's 10 to 1, probably conservative. So the vast majority of real estate in this country falls into this middle market category. Just walk outside when you leave today and look around you and say, that one's $50 million or more, or that one's $50 million or less. You will have a lot more in the $50 million or less category. Okay? Now, you take it one level further. Who owns these buildings? Well, we know we've been doing this a long time. These are not institutionally owned buildings. These buildings are owned by individuals and partnerships of individuals. Okay? Now let's go one step further. Who are these people? See a lot of them in the room. These people are typically males between the ages of 50 and 75 years old. So what happens to males who are between 50 and 75 years old? The polite term, we'll call it life events. Okay? So, what you are about to enter over the next 15 years is the greatest transfer of real estate the world has ever seen. And if you say, well, Jay, what about the 40-year-olds that own real estate? They got blown up in 2008. We've lost a generation of ownership. So the vast majority of that $10 trillion sits with males between the ages of 50 and 75. And we know we have death, divorce, health, retirement, all kinds of issues that are going to lead that ownership to say, I'm out of this building. So follow me for a second. Dad's 85. Dad owns a shopping center. Dad, unfortunately, passes away. Daughter is a dentist. Well, daughter then inherits this property. Doesn't have to go outside. But daughter's a dentist. Dad's 85. Guess what? When you're 85, you don't put a lot of money in CapEx. So now we have a building with a lot of deferred maintenance. Daughter's a dentist. Now this thing is coming back into the marketplace. And it's coming back into the marketplace looking, that's going to get retraded to sell to somebody else who has to put together a capital stack of debt and who has to put together a capital stack of equity. That is an opportunity. And then you blend that opportunity with the regulations that are going on with the banks who are being pressured to do less of this. The CMBS market, who just got totally revised for those who don't know in the room, a thing called risk retention that finally came out of Dodd-Frank that took 10 years to change the industry that frankly got us into 2008. 10 years, 8 years later, risk retention has come in, has reshaped that whole industry, and has now pushed a lot of the lending and a lot of the finance back to private capital, which was the intent of the government. So it doesn't have capital in these assets are not insured by the federal government. Therein lies this opportunity that we're seeking to expand. When you want to drill down a little bit further and kind of bring this discussion up, where are we? We're in really two significantly different places. There is a macro view that if you hang out here, it's nerve-wracking, right? It's, Europe's in trouble, there's negative interest rates, China's slowing, I mean, it's all bad. And it is. But that's the macro view. You go to the Main Street, the guy who has that B apartment building, who is renting that to regular people, working class people, for $1,000 a month for a 2-bedroom apartment, they're full. You go to the industrial buildings, they're full. Right? Main Street is not feeling all this angst. The angst is coming out of the economy, the economics, and what's going on. What's actually going on in Europe is good for us because we're the best thing standing, and money is flowing in. And it's flowing in and it's pushing down the interest rates, which in theory everyone's going to say is going to push up values, and it will on the trophy assets. It will not on the middle market assets. Because on the middle market assets, you are not going to see that capital flow from Singapore going into a $20 million apartment property in Austin. And those $20 million properties in Austin already have pretty low cap rates. A lot of that's baked in. So what's happening in this middle market is what's going to drive these values is going to be operations, NOI. And you've got to buy things that are going to be in demand and that can be well run and that can lift the values through the bottom line. And in fact, I would argue on the middle market assets, your cost of operating those assets, even in a declining interest rate environment, is going up because the financing that is available to those middle market assets has now changed as the regulations have taken away a lot of the banks. We'll let Marty speak to that. Certainly it's taken away cheap CMBS. CMBS is going up. When it brings in private capital like us, and private capital like us, our return thresholds haven't really changed. My investors still want 20%. They're not saying 8's fine. So the returns that the equity and the debt is looking on this middle market is actually going up. So as interest rates fall, we don't see that those assets actually going up in value. We see those assets either staying the same or actually we've said in our market letter in 2015, in November of 15, that we're projecting a 3 to 8% value decline over the middle market assets due to the factors that I just described. And the other factor is the nervousness of big equity. And when big equity tightens up, banks tighten up, and capital is harder to find. So in the big picture, where does that leave us with interest rates? Certainly lower for longer. I mean, we've been calling for interest rate increase for forever, but it's clear now that it's not going to happen for a long time. What could derail this whole thing? And I'm a big bear, so it's not like I'm up here happy about saying everything's great. I'm a distressed guy who loved 2008, and also, for those of you in the room, loved 1992, and would love to get back to that, but we're not. Main Street's fine. Main Street's going to be fine. You're going to see macroeconomic events like Brexit. Who's next? Is France next? The EU starts to unwind. You will see that cause volatility, but it's not hurting the guy who is selling the plumbing fixtures in the industrial space. So you have a real disconnect there. I really don't see anything over the near term that derails. It's not like we're going up. It's just flat. It's just going to be, same time tomorrow kind of play. The only thing that can derail this thing appears to be people don't show up for a U.S. Treasury auction. It's hard to imagine, given the rest of the world, if you don't show up for a U.S. Treasury auction, unless you want to connect a bunch of dots and you say that Donald Trump gets elected and defaults on U.S. debt, then maybe people don't show up. But other than that, it's really hard to see that happen. The wild card would be if the U.S. would go to negative rates. That seems unbelievable, but for those of you that are following the negative rates that are going on, savers have to pay the bank to keep their money, and borrowers actually get paid to borrow money. That's a crazy world. If that was to come here, I think all bets are off, but I think we'll see a 1% Treasury, but I don't think it's going to have a great impact on what's going to happen in the middle market commercial real estate space. That is a tactical space, and that is all about operations. And then we can go back to what I started with. The greatest real estate transfer of our lifetime in the history of the world is starting now and will run for another 15 years, and that's going to be the opportunity set that you should be paying attention to. Thank you.
So, are we in a Groundhog Day economy? What are the impediments for the economy to progress? Is the impediment Uncle Sam? There are some thoughts here that there have been. I actually had a chart that I wanted to share as a teaser as I am teeing this up for Marty's comments. And this was actually here. These are how much the regulatory environment is costing people. It's just a chart. Another one is the size of our debt. But the size of our debt is not the only thing. The problem is also that the deficit is still there and is running. There's also the amount of, I cannot measure it in man hours or man weeks. It probably is measured in many years, the amount of time that financial institutions have to spend with the regulators. I would like to ask the audience, how many people here in the room think that they are paying too much taxes? Come on, you're there. How many people think that we're paying just about the right amount of taxes? And how many people think that we're not paying enough taxes? Okay, so there is probably enough material in the room to have a very interesting and lively debate. I would like to invite Marty Schmitz to come here because it's such a thrill to speak from here, to share some of your thoughts of what you're seeing in your role in terms of regulations, in terms of how much time you have to spend with the regulators. Marty Schmitz.
Thank you.
Thank you very much.
Okay. First of all, I do want to mention Ron because Ron contacted me early on in this process, and I thought, I don't know if I'm going to do that or whatever. But to start one of these events from scratch, and I did it myself. 18 years ago we had an economic event. But anyhow, I just want to thank Ron for putting everything together because it's not easy, especially when you're starting. So anyhow, a couple things I wanted to touch on, and maybe I'm kind of wrap things up and give everybody a feel as to what's going on the street level. I thought Charles had a lot of very good points in his comments that he was talking about on the Fed and everything. So I thought I'd just give you a few things that we're seeing from the banking industry and stuff like that. We're a family-owned community bank, about $1.35 billion in assets. I love that because you're kind of in the middle of everything. We see financial statements on 15 companies a week come through loan committee. You kind of get a pretty good feel for what's going on, not only in the real estate, but just operating businesses and things like that. And that's something that so I think we do have a pretty good feel as far as what we're seeing, stuff like that. It touched on the regulatory side of things. I'm going to put a few things in on the banking industry that I don't think people really realize, you know, how it works. I think it's a mystery to a lot of people until you're in the middle of it. I'm kind of unique because I spent half of my career in commercial real estate and half in banking, so I do have a pretty good, you know, feel for what Jay's doing and things like that. I'll try to weave it in here, but the regulatory situation with Dodd-Frank. So Dodd-Frank on its own was 2,700 pages. But what people don't realize, and Obamacare was, I think, 2,400 or something like that, but what people don't realize is Dodd-Frank was merely instructions on how to write regulations. So we are currently up to 22,000 pages of regulations, and it's about 2/3 implemented. I mean, I don't know about you, but not too many people want a playbook that starts with 22,000 pages of how to do things. Personally, my feel is they could have done it in one. They could have increased capital levels, and they could have reinstated Glass-Steagall, and probably would have accomplished more than they did with the regulatory stuff. I don't know if you have any thoughts on that, but it is pretty overwhelming. You know, they did increase capital levels from 8 to 12%. I think that's something that made some sense to do, but a lot of the rest of it, there's a whole lot of digging holes and filling them up, and some of the pet peeves, they seem to be caught up in Washington. They get quality mixed up with quantity, and they think quantity equates to quality, and that's not really the case. If they could keep it simple, they could have accomplished a lot much easier. What we see from the local side is we do see loan demand starting to come up. It's been a long time since we've seen that happen. That's an indicator of what's going on, I think in particular, what's going on in Denver. Denver's a very bright spot on the national economy, so we do see the loan demand starting to come up. This, I can foresee in the future that deposits will start to be a little bit more valuable. They haven't been very valuable over the last 5-7 years, primarily because we as banks had to hold capital against deposits to us or liabilities that we owe people. We had to hold capital against that, so there hasn't been a big demand, and the rates have been very low. I think you'll see that start to change a little bit as time goes on. Real estate, Jay kind of touched on that, the banks, and just a little bit of background on how it all works from a regulatory standpoint. Back in 2006, the regulators issued what they called guidance for banks, in which they didn't want to have any more than 300% of your capital in non-owner occupied commercial real estate. And I remember when they came out in that, with that guidance, and I said, you know, they're absolutely right on, because there's way too much money coming into the real estate industry. But as often happens, what they did is they didn't pay much attention to it, so they just continued to let banks build up in commercial real estate, and they did what banks should do. There was nobody slapping their hand and everything until, for those of you in the industry, June of 2008, they came in and said, not only is it not guidance, it's the rule, and you've got to get down those levels. Well, they had a couple of years of banks just ratcheting up their balance sheets with commercial real estate, and the music stopped on the back when they came in and did that. So, now everybody's getting in line. They're getting in line with it, in the 300% range, but we're starting to hear again that they're starting to push. They're not trying to push it down, but they're watching you closely. They don't want to see that ratchet up again. Excuse me. What we see from our operating customers, I mean, balance sheets are pretty healthy. And again, Denver's a pretty good spot right now as far as what's going on. And that's not just, the real estate side, but that's operating companies. And we bank pretty much everything under the sun as far as different types of companies, but we haven't seen any deterioration on that. Profits seem to be pretty good. A couple other things let me kind of touch on. Charles kind of mentioned it. He talked about the loans to banks, which is quite often always referred to as bailouts. And I think it's important to realize that what was referred to as a bailout was anything but. It was loans to institutions to try to bring liquidity into the market. And as of a couple months ago, the federal government had earned $30 billion on what the TARP or the bank bailout stuff. So it was an investment as much as anything in there. They lost $9.2 billion on the auto. That would be probably more considered like a bailout. And then they made about $5.1 million on the AIG loans that they made over in that way. So I think it's important to understand, how that all works and everything. Let me kind of touch on a few other things just from a real estate standpoint or what we see. I think we're concerned about apartments in Denver as far as the overbuilding. Jay may have some good. Well, Jay doesn't know anything in Denver. He's all over the place.
We're not in Denver. We have no positions in Denver. We think we'll have some apartments here in the next couple of years.
Yeah. Exactly. We're concerned, and my concern is on apartments is, so we see probably ticking up to about a 10% vacancy rate. That in itself, you can kind of work through that. That's not terrible. But what I see is when you get, and I think it kind of gets lost in the equation, when you go from a 3 or 4% vacancy and working on up to 10%, people buying apartments at 4% cap rates, and if you can't project increased rental rates, as in a 10% market will do that, all of a sudden that 4% becomes 5%. And I said, well, that's 1%. Well, that's 25% of your purchase price when you roll a 4% cap to a 5%, and that's basically called equity in a lot of projects. Industrial in Denver's hot as could be, primarily due to the cannabis and them taking out a lot of space. Retail, I don't have some good numbers on retail, but it seems to be moving right along. We are seeing some weaknesses start to creep into the office side, and a lot of that has to do with the oil and gas. It seems to be very spotty. If you go to lower downtown, there's still a lot of demand there. Further south there is, but if you go over to the eastern side of downtown or kind of the northern tech center area, there's some weakness in there that we're not seeing filled. So I do think Denver's doing all the right things as far as where they're putting their money. The DIA train is a huge asset. We are investing in infrastructure and the type of things that I think speak to the longevity of Denver and the capabilities. However, I will say we're probably more aligned with the national economy than we've ever been as far as some of the things that we're doing. So I think we're doing the right things. We're ahead of things, but got to be a little bit careful. So that's it. Thank you.
Well.
We were on a mission against the clock to leave enough room and time for questions from the audience. I would like to now give the audience an opportunity to ask questions. I believe there is a microphone floating around. Questions or comments, suggestions, please.
Sure, well this is for anybody who's spoken today. I guess you can hear me without the mic. Well, the elephant in the room is, at least it's been mentioned once, Donald Trump. My reading of Ben Bernanke's book and guidance for him was that the President of the United States had a hell of a lot of things to do with the Federal Reserve. They threw a lot of stuff up on the wall. I'm not sure that, you've been talking about Congress, but I think the presidency has something to do with how the Fed works and how our monetary supply works. Not focusing just on that, but I'd like, let's hear how the election's going to play out if Donald Trump is elected president. And what kind of
Can anybody picture that scenario?
Well, when we look at that, we actually, we like volatility. Volatility is our friend. So a Donald Trump presidency would create a lot of opportunities, and so on that basis alone, we're bullish on the volatility that would be created in that presidency.
I just add, I've been betting against him for 6-8 months, and I was formerly state party vice chair for the Republican Party 20 years ago, and he has stunned me at every turn, every corner. So what really surprised me is my good friend Steve Moore agreed to be an economic advisor to him. Steve was being pursued by a number of the Republican candidates and held off, but he was actually on the radio this morning. Steve's been advising him for about 2 months, and as far as I'm concerned, that's a good sign. So I just think there's a lot more to the stories. Things that we can't expect are going to happen before the election. So,
A question here.
John, when you put up that chart, when you take social costs per barrel into consideration, do you have a view on what's going to happen in the Middle East as a result of these low oil prices and what its impact is going to be on the stability there, elsewhere in the world? And if you don't have an opinion, that's okay, because I know you're not a politician, but...
No, actually I do. 10 days before they announced they would not cut their production quota, Saudi Arabia announced that they were going to double the depth of their security border between Yemen and Saudi Arabia and Iraq. And so that security border went from 10 miles to 20 miles. And it was such a tell in terms of what they might do 10 days later that I'm surprised a lot of people didn't make a lot of money on it. If you look, and if you know folks that have lived in Saudi Arabia, there are certain parts of Saudi Arabia that are crumbling from within. And the royal family is doing everything that they can to maintain control there. I would not be surprised in 10 years to see that family fall. And can you imagine the repercussion of that throughout the world? Let me ask you this. Would you feel, if you were one of the Saudi royal family members, that the U.S. was an ally? And then let me ask a really tough question of all of you. The medium-range Shabbat missile from Iran is a 7-minute flight away from the largest oil field in the world, the Ghawar field in Saudi Arabia. If Iran decided to attack that oil field and take out 10% of the world's production, you'd guarantee their economy and Russia's economy for the next 20 years. What would the United States do the next day? Would we even respond right now? I think that answer, that you don't have an automatic answer like you might have 10 years ago, is the answer. So, I see that whole region as being unstable for some time. I'd love to hear any comments. Does anybody think the United States would respond to such an action? Raise your hand if you think they would. There's your answer. That's a stunner to get that answer. So imagine how Israel feels. How many people would go to Israel for a vacation or a pilgrimage? Raise your hand. I took my wife and 3 kids, one of which is in the back of the room there 3 years ago. It's safe. There are certain parts of Denver as a third-generation native that I avoid, but it's safe in Israel. It is. I'd take them there again tomorrow. But I think that kind of answer lays out. You could write books about the issue over there, and they have been, and they are being written.
There's perhaps room for one more quick question. Not regarding Trump. Going once.
Well, this is for Jay. Where do you think? Let's say today there is an office building here, one of the ones that you mentioned in the middle market, that is selling at a 6 cap. What do you think it'll be selling at 5 years from now?
It's going to be, that cap rate, well, it's not about the cap rate in that building. It's about the tenancy in that building. And it's about, is it full? What rent are they paying? So if you took a building here downtown with a constrained supply for the most part, a lot of buildings don't get built in downtown Denver. It's a tougher office environment. And if you told me that you were going to keep raising those rents to market, or the market's going to increase, and you were bullish on the market, and you thought you could get good tenancy in there that had some credit to it, it may trade at a 6 cap again. I wouldn't underwrite it as a 6 cap again. I'd want to know that we can make money. We could hit our target at a 7 to a 7.5, and that our principal's protected to an 8 or a 9. And then if it trades at a 6, then that's a bonus. But you don't want to turn real estate into a game of interest rate futures. You can go buy interest rate futures and do that. So it's going to come back to the net operating income and the quality of the building and the tenancy. But if you buy it at a 6 and the market goes up, and probably will because it's Denver and things are doing fine, and you sell it again at a 6, you'll make money. But don't underwrite it on that premise. Build in a margin of safety.
I would like to take this opportunity to thank you all. I would like to invite you all to continue all of these discussions. We're discussing, Ron, I'll have a conference in November in Boulder, if you can endure Route 36 and drive all the way up there at the school. And on that note, I would like to pass the microphone back to David.
Thank you. Can we thank a marvelous panel? Can I close?
Yes,
my partner and I were trying to figure out, Ron and I, how we're going to end this. So if you'll give me permission to speak on behalf of both of us.
Absolutely.
We've been sitting now for a number of hours. We talked about interest rates, remarkable events. We talked about the great geography of the world in different terms. So this is now a 2-minute plug for the Global Interdependence Center. The middle name is interdependence. And what we have studied when I was program chair and now still on the board, and others who are on the board or active with us around the world, what we study and talk about is interdependence. You just heard an example of a negative interdependency, and that was in the Middle East, a place I visited in my lifetime about 25 times. And the interdependency of a 7-minute missile. Interdependence isn't only positive. There are positive interdependencies and negative interdependencies. We talked about credit. One of the examples that one of our board members, Catherine Mann, who is now a chief economist at the OECD, she was a professor at Brandeis before that appointment, uses is the model of the alcoholic in the liquor store. And she uses it as an example of a negative interdependence. The alcoholic goes to the liquor store extends credit. Accounts receivables go up, they're pledged as collateral for a bank loan to buy replacement inventory. The business shows a profitable financial statement. There's a negative interdependency between the alcoholic and the liquor store until a shock comes. So in the GIC for almost half a century, we have written about, talked about, and tried to convene, as we did today, from a neutral position, a dialogue. We don't seek an outcome. The dialogue is the outcome. And if people of goodwill will spend 3 or 4 hours like this in very thought-provoking conversations, and then take it away and think about it and talk about it, maybe we will attempt to make the world, we'll attempt, it's a tough job, to make the world a little better place. So for the Global Interdependence Center, we were able to partner with the Denver chapter of Business Economists. Ron, we thank you. We thank you for joining us and sponsoring it. We thank you for partnering with us. And we hope you enjoyed the morning. And we'll end with a promise that the Global Interdependence Center makes. Today at this meeting, you heard forecasts. Opinions, but forecasts. Here is the issue when it comes to those forecasts. You come to a Global Interdependence Center meeting. You take away a forecast. We come back to Denver. We partner again. We have another meeting. You bring the forecast back to that meeting. And we guarantee you, we'll give you a new one. Thank you very much.